long-term capital for productive investment. And I'm happy with the work we have done so far. My sister Abna is right here, very, very passionate about that project. We are thankful. Colleagues, our new FX operations framework that we introduced last year has enhanced the transparency and predictability of our FX operations, and we will continue to work on that framework going forward. We are also rebuilding external buffers further through the gold accumulation program under the Ghana Accelerated National Reserve Accumulation Policy, or what we call the GANRAP, in coordination with the Ministry of Finance. Now, the government securities market has evolved profoundly indeed. During the period of heightened uncertainty, investors understandably favored shorter-dated instruments, with treasury bills becoming the dominant segment of the market as investors sought to minimize duration and interest rate risk. The most significant development this year is the reopening of the domestic bond market. You remember in March, following the expiry of the 3-year restriction imposed under the debt exchange, the government boldly re-entered the bond market for the first time since 2022, issuing a 7-year cedi-denominated bond, which settled in April. This, to us, was a milestone. It was a transition from crisis management to active, orderly debt management. And to support it, the framework of primary dealers and bond market specialists has been strengthened, with the new bonds trading on the Ghana fixed income market. The improvement in conditions is visible in both pricing and participation also. Treasury bill yields have fallen dramatically as inflation and the policy rate declined. The 91-day rate moving from above 35% in early 2023 to single digits this year. Demand has been strong. Weekly auctions through late 2025 and early 2026 were consistently oversubscribed. And this reflected deep liquidity in the banking sector and renewed appetite for sovereign paper. More recently, the market has become more two-sided, with episodes of softer demand and yields firming modestly, which I regard as healthy normalization. That is a market finding its own level, rather than one that is driven by distress. More importantly also, participation is broadening. The restoration of confidence has drawn in domestic investors of every kind: banks, pension funds, insurers, fund managers, and other institutions. And the reopening of the bond market has restored the long-dated investment options that institutional investors had lacked since the restructuring. So our objective is clear: to rebuild a credible yield curve, because government securities are the benchmark against which corporate bonds, infrastructure instruments, and other private debts are priced. Liquidity is central to that endeavor, and it remains a priority of the Bank of Ghana. Now, on the outlook and implications for market participants, the fixed income market is far more than just a financing platform. It is a critical channel for monetary policy transmission, a benchmark for pricing risk. It is a source of long-term capital and an important pillar of financial sector development. Its outlook Its outlook is therefore closely linked to the broader macroeconomic recovery. And as inflation remains contained, fiscal conditions improving, and confidence strengthening, we should expect the market to become deeper, the market to be more liquid, and the market to be more stable. We also expect greater participation by corporate and quasi-governmental issuers. For instance, the Ghana Cocoa Board has indicated its intention to finance operations for the 2026-2027 crop season through commercial paper issuances, and they are targeting about $1 billion in 3 phases. Such developments point to the growing potential of the Ghana fixed income market as an alternative source of financing for businesses and other institutions. So looking ahead, and as I draw to the end, I expect to see 3 important transformations in the near term. First, we should see greater diversification of issuers and instruments going forward. Government securities currently dominate Ghana's debt capital market. And as macroeconomic conditions improve further and interest rates moderate, we would like to see a greater presence of private sector issuers through commercial papers and corporate bonds. This will require us to continue addressing the structural and liquidity constraints that may discourage private sector participation and to develop frameworks that make market-based financing more accessible, more efficient, and more attractive to corporate issuers. The second is that we should see greater use of technology. And this is to deepen market participation and improve market efficiency. We can leverage financial technology to develop platforms that are integrated with the Central Securities Depository and facilitate the seamless exchange of funds and securities. Such platforms can improve transparency, efficiency, and convenience for market participants, while also supporting greater participation in the secondary debt markets. And third, we should see greater mobilization of domestic and diaspora savings into long-term investments. These are ongoing institutional collaborations. There are ongoing institutional collaborations to develop safer and more efficient investment channels for domestic investors and the Ghanaian diaspora. These initiatives seek to provide Ghanaians abroad with secure opportunities to invest in debt instruments and productive sectors of the domestic economy. The Bank of Ghana is also leading initiatives under the Remit to Invest program, which seeks to channel a greater proportion of diaspora remittances towards sustainable long-term investments. And next week, I will be speaking to a large diaspora gathering, Ghanaian diaspora gathering in the US. I will make these points very strongly there. Certainly, these transformations will not happen automatically. They will require continued collaboration among key stakeholders. They will also require continued attention to market infrastructure, investor protection, transparency, financial literacy, and the development of appropriate regulatory frameworks. So in conclusion, colleagues, the proof of a deeper debt capital market will not be found only on an auction sheet. Not at all. Remember, it will be found in that power project that was completed. It will be found in that factory that got expanded. It will be found in the housing development that was financed, and it will be found in the SME that finds room on a bank's balance sheet just because the right capital reached the right use. So last April, and as I said, the market was in effect asked to look at 7 years into Ghana's future. The answer of the market was encouraging then. And our task now is to make those 7 years credible and to build a market that can look even further. So let me once again commend Fidelity Bank for convening this important conference. Platforms such as this, they provide an opportunity for constructive engagement among market participants and policymakers, and they can help shape the future of Ghana's debt capital market. I hope that the discussions, yes, go ahead and clap. I hope that the discussions at this conference will advance the ideas, institutions, and market confidence that is needed to transform our current economic recovery into greater resilience, investment into opportunity, and growth into lasting prosperity for all Ghanaians. Good morning.
Ladies and gentlemen, a round of applause, please. Thank you, and thank you as well for that standing ovation, and rightly so deserved. Please, round of applause, ladies and gentlemen, for the Governor of the Central Bank, Dr. Johnson Pandit Isiama. He's lived up to his name, Pandit, is it not? But we're going to take a few pictures. He would have to take leave of us, so I'll kindly ask the manager, please take your seats. Thank you so much. I kindly ask the Managing Director of Fidelity Bank, Mr. Bode, kindly join the Governor. Also, the CEO of the Ghana Stock Exchange. Thank you so much. Mr. Kwame Pianim, if you could kindly join as well. Thank you very much. Thank you. And we also have the CEO of the Ghana Association of Banks as well, please, Ms. Ewa. Thank you very much. After which, I'll kindly ask the DMDs of Fidelity Bank and all the directors to also join. Thank you very much. And as the Governor of the Central Bank indicated, growth 6% in the second quarter, the second half of 2026. Strong gold and cocoa receipts bringing in $8.8 billion. Please, let's have the various directors, Deputy Managing Director, and all the directors of Fidelity Bank, please kindly join. Thank you very much. Rating agencies' improved rating reflects the growth that we're experiencing as a country, and also the priorities of the central bank safeguarding financial sector stability, which is key to why we're here this morning, and strengthening resilience as well. And the greater presence of private sector issuance is one of the expectations going forward, and also the right capital reaching the right use. Ladies and gentlemen, we're live on Joy 99.7. Thank you so much. Thank you very much. Please, let's put our hands together for them as they make their way back to their seats. We're live on Joy 99.7 FM, also live on the bank's social media handles. And also, we're going to hear from the Ghana Stock Exchange. And it's critical because the Governor of the Central Bank did indicate that incentivizing banks to list on the capital market is one that we should also, in fact, it's been worked on, and to contribute to the expansion of the financial sector, to contribute to the growth of the economy, as we're seeing. And the person who has been passionate about driving and ensuring that this comes to pass, we're going to be hearing from him shortly. But before that, please, distinguished ladies and gentlemen, help me acknowledge the presence of Mr. Kwame Pianim, economist and investment consultant. Let's put our hands together. Thank you, sir. Also joining us, we have Mr. John Ewa, the CEO of the Ghana Association of Banks. Let's put our hands together for Mr. Ewa. Also with us is Dr. Theo Echampong, is a technical advisor at the Ministry of Finance, is an economist and political risk analyst. Theo, please. Yeah, he was with us in the media. He's a big man now. So, Dr. Theo Echampong, it's good to see you. Also, they would make up the first panel that we will be getting into shortly. But Abena Amoah was appointed Managing Director of the Ghana Stock Exchange in November 2022. Ms. Amoah has worked in the capital market industry for over 20 years and is highly respected for her technical knowledge, business acumen, outstanding professionalism, and integrity. She was appointed as the chairperson of the International Capital Market Committee of Regional Representatives in June 2026. CRL is a liaison between the ICMA board and its 15 regional committees and chapters, serving the over 630 member institutions across 71 jurisdictions. Abena was elected as a board member of ICMA in June 2025 and serves as a co-chair of the Pan-African Committee for the same institution. In 2023, the World Federation of Exchanges named her as one of the global top 20 women leaders. Let's put our hands together. She also served on the executive committee of the African Securities Exchange Association. She previously worked as a senior advisor with the Black Ivy Group LLC, Renaissance Group, where she was CEO of New World Renaissance Securities Limited. She is an alumna of the University of Ghana Business School. In 2023, she was awarded an honorary doctorate degree by the University of Ghana for her immense contribution to industry. She has also undertaken academic and leadership studies at global institutions such as the Stanford Graduate School of Business and Harvard Business School. Ladies and gentlemen, please help me make welcome Madam Abena Amoah, Managing Director, CEO, Ghana Stock Exchange. Thank you very much.
Thank you very much, and a good morning to everyone. Good morning. Good to be here, and I was feeling a bit embarrassed when I was hearing all that he was reading. It's so sad to have that honorary doctorate and not be able to use the Dr. Amoah like Dr. Echampong. So, Theo, hand yours over to me, okay? At least I'll make it legit. Distinguished guests, my own father, Mr. Kwame Pianim, the CEO and the leadership of Fidelity Bank Ghana PLC. I love the word PLC because every PLC ends up near me. So I'm working on Fidelity and a few others. But it's really a wonderful pleasure to be here with you this morning. And it's important because we are here to discuss a market that is central to Ghana's economic future, and that is the debt capital market. So whilst I congratulate Fidelity Bank for putting us all together, because it's so timely and it's so important that we have these discussions. I'm waiting for my presentation to be loaded, but I think the theme for today's program brilliantly captures an important transition that we are all in. Today, we no longer speak only about how Ghana built a market or about the stresses that tested it. And long have we discussed those stresses. But we are now asking a more forward-looking question. That is, how do we turn this recovery that we are seeing into resilience and, more importantly, into growth? And how we never, ever, ever, ever go back to where we've come from. Ghana's debt capital market has made meaningful progress. The macroeconomic conditions have improved. We've had the governor take us through a lot of the data that confirms this. People ask, how am I feeling this in my pockets? I'm sure the answer to that is also coming. Investor confidence is returning. Liquidity, as we are running the fixed income market and the equities market, we are beginning to see this re-enter. But recovery alone is not the destination. For us, the next task is to build a market that is deeper, broader, more transparent, and more useful to both issuers and investors. So, I've been asked to go on, but I prepared, my team actually had spent all night preparing these beautiful slides. You will see all of them before I leave here. But I'll carry on. So for us to understand where we are going, it's very important to remember where we began. And it goes back to the founding or the organization of an existing debt capital market into what today we call the Ghana Fixed Income Market, which was established in August 2015. Last year, we celebrated 10 years of the market's founding. So we've done the first decade, and here we walk into the next decade. But the founding of the Ghana Fixed Income Market was not by just one institution acting alone. It was through the cooperation of the Ministry of Finance, the Bank of Ghana, the Ghana Stock Exchange, the Central Securities Depository, the Financial Markets Association, and I see the president here for Africa, the Ghana Association of Banks, and the licensed dealing members of the Ghana Stock Exchange. Ladies and gentlemen, I share that history because it matters. And it matters because markets are institutions of trust. They depend on common rules, reliable infrastructure, credible participants, and confidence that an instrument can be issued, it can be settled, it can be traded, valued, and used again after the initial transaction. Our recent story begins with the macroeconomic environment, what I call the linchpin of our market. The Bank of Ghana's monetary policy, together with the work that our Ministry of Finance has done, has helped bring inflation down and restored a measure of stability. But more predictable inflation helps investors assess real returns, while fiscal discipline improves the outlook for government financing. As confidence returns, liquidity that had remained on the sidelines is moving back into Ghana's capital markets, creating an opportunity for both government and corporate issuers. For us, the second major turning point was the domestic debt exchange program, together with the restructuring of our external obligations. Between 2020 and 2024, Ghana's total public debt rose steadily. The restructuring process then changed the trajectory. The public debt to GDP ratio declined from 81% in 2020 to 45% by June 2026. Ladies and gentlemen, indeed, our finance minister has stated in recent days that the percentage of revenues used to service our debt is now below 20%. A significant improvement from days when over 50% of revenues was used to service our debts. That represents a change in the sustainability conversation. It reduces financing pressure, it supports the credibility of the fiscal outlook, and creates the conditions for investors to reassess Ghana's debt markets. However, restructuring also creates new sets of market questions. The issue is no longer about the size of the outstanding debt. It's whether that debt is usable and what can we do with it. So that's why we must bring our minds back to our benchmarks. Do we have benchmark clients large enough to support two-way trading? Where are treasurers in the room? Can investors use the securities efficiently as collateral? Do the instruments trade regularly enough to produce reliable prices? These are practical questions that measure market quality. A security may exist on a balance sheet, yet still fail to deliver full value if it cannot be priced, financed, transferred, or traded efficiently. Thank you very much to the tech team. Well done. These are the challenges of going digital, right? As I said, you're going to look at all of these slides that I've already talked to. But I love that picture in the corner over there. I think I wanted to show especially where we have come from in terms of inflation, right? So the governor talked to some of these, but nothing beats the picture. How we went up the top of the mountain and oversaw everything. We climbed Mount Everest, and how we've safely come down to base camp. So what do we do now that we are at base camp? And how do we ensure we stay there? So, ladies and gentlemen, the structure of Ghana's debt capital market remains highly concentrated around sovereign issuance. Govies have consistently represented the overwhelming share of outstanding debt instruments, as you can see on the slide, while corporate bonds remain a relatively small segment. Government paper provides scale and a reference curve, but a market built predominantly around one issuer cannot achieve its full potential without broader private sector participation. The timeline of corporate listings shows that 24.4 billion has been raised from the market, but mostly again from government-linked corporates, namely ESLA, Dache, and Cocoa Board. But with growing activity from other corporates, so here I want us to pay attention to Bayport, Lesego, Quantum, Federated Commodities, Casaprecon, and the latest kid on the block, Petrosol. It's been a long and winding road. But the market still needs more issuers and sectors, such as banks and financial services, manufacturing and infrastructure, repeat issuance, and continuity. The secondary market gives us another important perspective. Following DDEP, secondary market activity was initially dampened by extended maturities, compressed yield differentials, and the adjustment to redesigned instruments. The new 7-year government bond has helped re-engage institutional investors and broaden participation across the yield curve, which must provide not only short-term cash management, but also duration and reference points for corporate pricing. And here, this brings me to the role of government paper as the market's liquidity engine. Treasury bills support short-term cash management, and notes and bonds support duration, benchmarks, refinancing, and corporate pricing. The data shown for January to July indicates a reported volume mix of 51% for notes and bonds and 47% for treasury bills, and only a paltry 1.4% for corporates. This represents a notable change from 2024, when activity was much more bill heavy, so approximately 120 billion in treasury bills compared to 50 billion in government notes and bonds. But we need both, bills to manage cash and bonds to establish a curve to support refinancing and create a basis for corporate issuance. Each instrument must play a clear role and connect efficiently to the others. The recovery of the domestic sovereign bond index, the S&P 1, marks the first sustained improvement since our restructuring cycle. Ladies and gentlemen, the yield curve also shows the effect of improved stability. By August 2026, my presentation shows indicative treasury bill rates of 5.76% for 91 days, 7.64% for 182 days, and about almost 13% for the 364-day bill. Lower yields reduce the government's cost of borrowing and improve debt sustainability. They can also reopen a refinancing window for issuers whose funding plans were previously constrained by high rates. At the same time, ladies and gentlemen, the presentation highlights substantial demand at the primary market auctions. Since early 2026, bid rejections have averaged approximately 12.8 billion Ghana cedis, leaving our banks and institutional investors with significant cash buffers. That excess liquidity is not only a government financing story, it is also an opportunity for credible corporates that can present well-structured transactions, clear disclosure, and appropriate risk-adjusted returns to access this money. This leads to what I will describe as the defining diversification gap in our market, the corporate market opportunity. Corporate securities outstanding stood at approximately 8.4 billion Ghana cedis in July, 87% of which is Ghana Cocoa Board. These figures are not an argument against the market. They are an argument for all of us to address the next stage of our development. A deeper corporate debt market would give companies access to longer-term financing, give investors greater choice, and reduce the pressure on banks to serve every financing need through their balance sheets. It would also allow the market to express meaningful differences in credit quality across sectors and business models. But to achieve that, 4 things are essential. First, issuers need credible disclosure and reliable financial reporting, not one set of accounts for the bank, one set of accounts for the taxman, and then the third set of accounts for the owner of the company. Second, the market needs credit differentiation and appropriate credit enhancements. Third, we need repeat issuance and covenant discipline. A healthy market is not built through one-off transactions. It's built when issuers return consistently, they meet their obligations and establish a performance history. And here, case in point, is what Bayport Savings and Loans PLC has been doing since 2015. Fourth, we need secondary market liquidity across sectors. The investor base provides a strong foundation, ladies and gentlemen, for us to look at. Institutional investors, when you look at this slide, you see that institutional investors, especially pension funds and investment firms, dominate the corporate bond holdings and show appetite for quality fixed income assets offering stable long-term returns. The next opportunity for us is to broaden participation from banks and retail investors so that different investor classes can contribute liquidity and absorb risk across the cycle. Ladies and gentlemen, a crucial point to note is that primary issuance and secondary liquidity are one and the same system. An auction addresses funding need and investor demand. Settlement provides delivery, cash, and finality. Trading provides price discovery and rebalancing. And repos provide cash liquidity and collateral mobility. If any one of these links is weak, the value of the entire market is reduced. And this is why, for us, the next frontier for our markets is full market digitalization and trusted data. Modernization can lower friction costs, friction across issuance, trading, settlement, and collateral management. It can reduce unnecessary rekeying, improve the consistency of instrument terms and life cycles, and make it easier for participants to rely on the same information. But modernization must be carefully managed to preserve trust, resilience, and two-way liquidity. Ghana can adopt foundational work and standards developed by the International Capital Markets Association, the largest global trade association for participants in the debt capital markets. At ICMA, where I serve as a board member, we have been actively supporting this transition through our FinTech and Digitalization Work Program, which brings together issuers, investors, banks, market infrastructure providers, law firms, significant opportunities to innovate quickly and build infrastructure designed for the future rather than the past. As digital market solutions mature, they have the potential to support greater financial inclusion, improve access to capital, and strengthen connections between domestic, regional, and international investors. Ladies and gentlemen, technology can make a market faster, but only governance and accountability make it dependable. In a debt capital market, the quality of data is inseparable from the quality of the trust placed in the market. So finally, allow me to suggest 5 priority actions that we need to build together in the next phase of the development of our fixed income market. Benchmark issuance. Dr. Champon, I know government is looking carefully, but we need a predictable curve built through appropriately sized and regularly quoted benchmark lines. Predictability helps investors plan, help dealers make markets, and helps corporates price their own debts. Second is liquidity. We must continue improving transparency, turnover, price discovery, and repo and collateral mobility. And that's why the GSE is partnering with the Bank of Ghana and the ICMA to adopt initiatives and build capacity with the aim to increase adoption of the GMRA among our market participants. You're not signing with each other, so we need to address that challenge. Third is corporate debt. More issuances on the market, and the corporate market should become a regular financing channel, not an occasional exception. And I call on the banks like Fidelity Bank, you must lead the way as issuers and as originators for your corporate clients. Fourth, I talked about earlier, which is digitalization and market modernization. And here I want to flag the recent improvements in the clearing and settlement infrastructure at the CSD and at the GSE as well, ongoing improvements in our market platforms to support such digitalization drives. And fifth is new markets, infrastructure bonds, sukuk bonds, sustainable bonds, securities lending and borrowing, derivative products. All these we have to work together to put in place to make the market more relevant. These priorities are connected. Benchmark issuance supports pricing. Pricing supports corporate issuance. Corporate issuance expands investor choice. Secondary liquidity makes investors more willing to participate. And modernized and sound infrastructure make the whole system more efficient. Ladies and gentlemen, so now I close with these reflections. We have indeed moved through a difficult period in our journey. We have faced pressure, restructuring, the need to rebuild confidence. Debt trajectory, improving bond performance, stronger liquidity, and renewed investor engagement. The responsibility now is to convert that recovery into lasting market capability. Our debt capital markets must do more than just finance governments. We need to support the productive sectors of the economy and give investors confidence. The next phase will be defined not only by how much activity returns, but how resilient, transparent, and inclusive that activity becomes. So, ladies and gentlemen, just like its beginning, the next phase of the Ghana fixed income market has to be built through cooperation between the Ministry of Finance, the Bank of Ghana, the Ghana Stock Exchange, the Central Securities Depository, the Financial Markets Association, the Ghana Association of Banks, the GIFM dealers, the investors, the SEC, all partners on hand. Our goal is clear. We must work and act to convert today's recovery inactivity into resilience in our financing system. Thank you very much for your attention.
Please, let's put our hands together for Madam Abna Amoa, Managing Director, CEO, Managing Director, CEO, Ghana Stock Exchange. Thank you. Sectors of the economy. And this, we would have the first panel member, Mr. Kwame Pianim, an economist and investment consultant of repute, has had distinguished career both in Ghana and abroad. He has worked as both a civil servant and a public servant in Ghana and as an economic research officer of the United Nations in New York. A former acting principal secretary, Ministry of Finance and Economic Planning, Kwame Pianim also served as an advisor to the Minister of Finance and Economic Planning in devising a market-oriented development strategy and program. While in the Finance Ministry, he also helped structure the Social Security Fund under the then State Insurance Corporation, SIC, into Social Security and National Insurance Trust, SNIT. As a private consultant, he designed and established the Teachers Fund for the Ghana National Association of Teachers. He is a former chief executive of the Ghana Cocoa Marketing Board and former chairman of the Public Utilities Regulatory Commission, PLC. Mr. Kwame Pianim has a lot to his name, and we celebrate him. Please, let's put our hands together. Let's put our hands together for Mr. Kwame Pianim. Thank you very much. And there's one thing that we can expect from Mr. Pianim. That's going to be a reality check of the state of affairs as we have it now. Get ready for that. Next, we have Mr. John Ewa, has a proven executive management track record for over 2.5 decades, driving corporate growth programs across various functional areas in financial services sector. He is the Chief Executive Officer of the Ghana Association of Banks, Before joining the Ghana Association of Banks, he was managing partner of Jewa & Co. Advisors, a financial services consulting firm. John is a fellow of the Association of Chartered Certified Accountants UK and a member of the Institute of Chartered Accountants Ghana. With several years post-qualification senior executive experience, he holds a Bachelor of Commerce degree from the University of Cape Coast and an MBA from Oxford Institute of International Finance. Ms. John Ewa has broad knowledge in investment banking and has been part of many landmark deals from his time at Ecobank Capital and Managing Director of UMB Bank. He serves on the following boards and national committees: Council Member, Chartered Institute of Bankers, Ghana, Council Member, Ghana Association of Banks, and many others. Please, let's put our hands together. Let's put our hands together for Mr. John Ewa. Thank you very much. And we're expecting the Deputy Finance Minister, Honorable Thomas Nyakwampim. We understand he's been held up in an equally important meeting, but thankfully he has delegated one person who has the full competence and capacity to do this job for us this morning. Dr. Theophilus Echampong is an economist, political risk specialist, and academic with over 15 years of experience in energy, extractives, and public finance. He's a technical advisor at Ghana's Ministry of Finance, focusing on fiscal rules, value for money, and public investment management in sectors like energy, oil and gas, and mining. He also sits on the Investment Advisory Committee overseeing Ghana's Oil Sovereign Wealth Fund. Before entering public service, Theo had delivered or co-led more than 60 consultancy projects advising governments, development finance institutions, and investors on economic and financial modeling, resource taxation and revenue management, macro fiscal reforms, and governance of strategic infrastructure and industrialization programs. Ladies and gentlemen, please help me make welcome Dr. Theo Echampong. Let's put our hands together for him. Thank you very much. And to moderate this all-important conversation this morning is a celebrated business journalist, editorial lead, Business Outlook Africa, Vivian Kai Loko. Let's put our hands together. Thank you very much.
Thank you very much, Alfred. When you have the likes of Mr. Pienim stand up for you when you get on stage, it puts you in a very funny situation. He's expecting so much, isn't he? I'll make you proud. Good morning to you all. Thank you for joining us for this all-important conversation. My name is Vivian Kai Loko. I am the editorial lead for Business Outlook Africa. Now, all these previous speakers have spoken about the good strides we are making when you look at the macroeconomic terrain. But the question for our discussion today is this sustainable, right? What can we do not to go back to the dark days? And based on the success of the terrain, what opportunities are there for the capital market? And thirdly, which I know most of the treasurers here and the CFOs are asking themselves, is this the right time to go on the capital debt market? So our very prominent panel would answer these questions for us. And then at a point, we'll put up the QR code for you to also ask any questions that you want addressed this morning. So thank you again and welcome to my panel. I'll start with you, Mr. Pini, because you've seen it all. All the times we've had good times and bad times, you've seen it. My question to you this morning, my first question is, this growth we are seeing, inflation single digit now, interest rates easing, Forex doing well, are all these sustainable? And what can we do so not to go back to the bad days?
Thank you very much. First of all, let me thank Fidelity Bank for convening this. It gives me confidence that the stability we are seeing now, when I look at the numbers, I say, wow. But I also know, as I was told once, that if you take purgative and you go to sleep, you wake up in a mess. We've done it 15, 16 times. Is it going to be sustainable? It's a little bit disappointing that the Minister of Finance is not here at the level expected. In my mind, 56 years, I've witnessed this scene. I've seen governors give speeches about the stability. But if we do not hold on to the macroeconomic stability carefully whilst we transition into growth, we'll wake up again in a mess, and then we will need to secure macroeconomic stability, which is secured at the expense of the disadvantaged among us. It's expensive, macroeconomic stability, if you don't have it. In my mind, the Minister for Finance is the one holding the bucket, pouring it on the floor, and the governor is given a broom to be mopping it up. The two of them have to be there to balance. And once we start the big spend, and the elections are coming, and we, you and I, demand freebies, then we'll slide into where we came from. So we need to build a lot of cooperation. Cooperation, not just, and Abnamwa listed the people we needed to cooperate, to collaborate with. Abna is confused sometimes because she calls me son because she's Breye and my mother is Breye. And he calls me father because we work together in a few things. But Abna, I would like to add to your list the courts, the judiciary. We need to build, maybe the tribunals we are talking about, build one that will protect the fund managers when somebody goes to build a hotel and issues a one-year note. Of course they cannot pay. You take them to the courts and the courts are delaying. We need a tribunal that will settle that. And the tribunal should be the end. You don't finish the tribunal and go and join the normal court. The end, if there needs to be a review, one appeal court judge, plus a finance person, a banker, three of them, the issue, and the guy has to pay. And the regulators have to be able to work together. If a bank in a financial institution or an insurance company borrows and they cannot pay, the regulator should move in very quickly, like Bank of Ghana, and take the bank over, put it under administration, so that we secure. We need to grow the capital and debt market, the domestic one. We are always preparing ourselves as a bride for Eurobond. What is Eurobond? It's the pension funds of Europeans. The domestic debt, pension funds, that is our resources. And I'll make one more suggestion so that we don't fall back. That is, we have to agree to grow prudently, what I call festina lente. We should not try to grow more than 6% a year. That means 18% if you take capital output ratio of 3:1, 18% investment for maintenance and new structures. If our savings, we are saving just 12 to 13%, then we need 5. Insurance companies should try to move from just less than 1% to 2% of GDP premiums. And insurance companies should make sure the rules are obeyed. If you are building a structure, a church, anything, you have to insure it. And that means liaising with the district assembly people to be able to do that. So we need to grow the funds that are domestic and use them, deploy them properly. And as has been said, I'll be happy to see that this thing is going on when the smart fund managers like Nana Safu and his colleagues from Stanbic issue bonds to make sure that the biggest artery road is on the Volta Lake, linking the consuming south to our northern bread basket. And I want us to see it, a continuation of what Nkrumah started. The Akosomo Dam was not just for power only, for irrigation, for that. And also when I see you issuing things for domestic agriculture, because we have to feed ourselves, and we can feed ourselves only we have. For electricity, all the digitalization we are talking about cannot work if you don't have cheap, effective power. And you cannot attract the numerous skilled people we have abroad. If they come, when they come, and they put their hand onto the wall, the power doesn't come on. They turn off the tap, and the water doesn't come. An old man like me, when I wake up in the morning, the first thing I do is call me PNM Water Company. Make sure my borehole is working. Call me PNM Electricity Company, turn it off. And I'm happy that Cocoa Board is going to borrow domestically. Our chief executive, we never borrowed outside. What we did was syndicate the banks. This idea of borrowing outside doesn't make sense. If you are chief executive Cocoa Board, you are not the best, most competent person to borrow money externally. It's the governor of the central bank. So I'm happy I see the trend, and I'm sure that this time around, we are not going to sleep and wake up in a mess after taking purgative.
Right. Which puts the spotlight on you, Dr. Theo. I mean, you have to make sure that we don't go back, take the purgative, and then run all over the place. What assurances are you giving us this morning that all the issues raised by Dr. Pienim and the concerns of all of us here to make sure we are on the right path, you do stay on the right path?
Thank you. Good morning, and it's good to be here. I bring you greetings from the Ministry of Finance and from the Minister and the Deputy who have to attend other very pressing national duties. I like how Uncle Pienim framed it in terms of taking the purgative, and you don't want to wake up in a mess. And sometimes we also say the proof of the pudding is in the eating. And you can see evidence of the hard work that has been done over the last 18 months in some of the numbers that Governor presented, and Abena and others also presented. What we're doing precisely is trying to deepen and entrench these reforms that we have started. So we recognize fully that given our history, given the fact that you've had to go to the IMF 17 times and we make progress and we retrogress, a number of reforms that you need to do and a number of things that you need to do needs to be further deepened and even institutionalized. So, for example, the stabilization that we have seen and what Governor spoke about now is being more and more institutionally sort of anchored. Let me explain that a little bit. We have made a number of changes, one, to the whole PFM, architecture. So for the first time in a long time, you actually have two core fiscal rules. The debt to GDP, which has been legislated, that cannot be more than 45%. And then we've also legislated a primary surplus rule currently of 1.5%. But with the PCI program that we have signed onto with the fund, the non-financing program, that will come down to 0.5% and gives us a bit of room for additional priority spending. But we're saying that that is not enough. You actually need other institutions to actually police these rules. So we do now have the Fiscal Council that has been set up as an independent body with a mandate to check compliance with the rules. Very much like what you have in the UK with the Office for Budget Responsibility, and in the US with the Congressional Budget Office, and several other jurisdictions. And the empirical evidence on this is quite clear, that stronger institutions to check the fiscals actually leads to better performance and prevent a repeat of some of the mistakes that we have seen in the past. In addition, importantly, as part of the whole fiscal architecture, is also the introduction of the commitment authorization regime. In the past, when the budget is approved, you have the MMDAs then go and spend. And sometimes you see certain liabilities crystallize as you get to the end of the fiscal year. What we've done this time around, and this is also institutionalized as part of the PFM architecture and the review of the law. Every project or every spending that an MMDA has to do needs to come for commitment authorization at the ministry, where we sit down, we review your numbers, and if we have to adjust or slash it down, certainly we will do that to prevent a relapse or recurrence of some of the issues that we have done. Also on the capital market and sort of the debt repayment side of things, currently our debt is sustainable, and for the first time in over 14 or so years, is classified as moderate with even room to absorb further shocks because of the reforms that has been done. But we're saying that we are not going to be sitting down and waiting for the maturities to come before you start running around looking for money to pay. So we actually have put in place the sinking fund. The sinking fund had been there since 2015. For close to over 10 years, you did not have much money put into the fund to retire these obligations. And in the media budget, we indicated that for the maturities that are due on the domestic debt next year and the year thereafter, we're putting money into the sinking fund to take care of that. But importantly, we're also saying that your non-oil GDP, a portion of that money is non-tax revenue, a portion of that money is being taken to be put right into the sinking fund to ensure that you have money available to take care of all of these, maturing debt obligations as and when they come.
Right.
And we also fully recognize that you actually have to grow the economy beyond the stability. Mm-hmm. So for us, it was always a two-year window to stabilize, and then the next phase really becomes how you engineer the 6-7% growth that Uncle Pianim talked about. But importantly, translating that also in private sector credit, such that you can get the credit share as a proportion of GDP. Currently, Ghana is among the lowest in the sub-region. It's, I think, around 10%. Our peers are doing 22-25%. You want to get into that 18 to 20 category, and you see that now come into the real sector of the economy. So a lot is being done, and a lot more is going to be done. But like we said, the proof of the pudding is in the eating. I think we've done enough to show that we are credibly going to enforce the reforms and ensure that some of the challenges that we had in the past are no longer repeated. So we don't want to wake up in a mess. We actually want to wake up in a very good position.
In a good position. Right, let me come to you, Mr. Ewa. I mean, Dr. Pianim has warned that we should stay on course, make sure we don't wake up in a bad position. Dr. Theo has given us good reasons for us to believe that things will be better this time around. But despite all these assurances that we hear and what we are seeing in terms of the improvements in the economy, are there still other concerns that investors have in wanting to explore the capital markets despite the improvements?
Of course, yes. If you track, you don't have to look too far back. If you are an investor, for you to begin asking yourself the same questions you asked Mr. PNM and the minister's representative, that is this stability built to last? And I'm assured, or we, all of us here have been assured by what has been said, but obviously if you're an investor out there and you are investing in an offshore market like ours, your concerns are broad. The first is you're coming on the heels of the domestic debt exchange, which obviously you take into account in your decision-making process. We are talking about macroeconomic fundamentals. That is what is attracting the investor population. So they will be looking at the inflation outlook. When you invest in an economy, you don't want, by the time you are going back, you are at the wrong end of the stick. So the inflation outlook is also important. Inflation now is good, but what is the projected inflation? How are we seeing into the future? And the governor spoke quite eloquently about it, that we are an economy that is very well, we are a small economy, but we are very plugged into the global economy because of our demand dynamics. We are very import dependent. So what happens elsewhere has a way of transmitting into what kind of things we can do here. So our ability to hold tight the inflation corridor is also critical for the investor who is coming, even for local investors as well, because everybody is looking for positive return. We don't want to go back into 2 years ago where we saw the returns in the negatives. And again, exchange rate becomes another variable for an investor to look at. Obviously, every investor, after investing, is looking at, okay, if tomorrow there's opportunity elsewhere and I want to, jump ship, how do I exit the market? So the secondary market activity is also critical. As you are attracting into the pool, you need to create outlet for people to exit. Those who want to exit, it could be exit to reinvest in the same economy or in the same market, but on different instruments. So we need to ensure that the confidence we are building, we build working with the fiscal, because a lot of the benefits we are reaping now is premised on the fiscal discipline that we've had in the last 18 months.
Yeah.
So a little shake-up in the fiscal discipline, and we are likely going to see some wobbling, and the investors are very wobbly because of where we are coming from. And I personally, and the last time I had an interaction with the minister, I mentioned it. Personally, our ability to withstand some of the shocks, which may potentially shift the discipline that we've had, we need to demonstrate strongly that we will stand firm when we have to. So I was worried when the fuel price jacked up, and immediately we said, oh, we are coming in with two CD to cushion.
Push it down.
That is an untargeted intervention. And it shakes me because potentially, the good thing is it was just for 30 days. But potentially, if that is left to hang for a long time, that is where it starts. When cocoa price on the world market declined, I was trying to look out for how quickly can we reprice. And it took us almost 3 months to do that. And that is another take, whether we will be quick enough to protect the fiscal position. So we need a lot to happen at the ministry level, the governance level, to generate that kind of trust and confidence in the debt capital market.
Right, so let's let the market forces play and stop getting involved too much. But Mr. PNM, the rates are going down. Somebody will say, well, perhaps, we've experienced good and bad times, things going back. Should they wait before they get into the market now, or should they get in now? And at what point does it become too expensive not to get involved?
I think that if you are an investor and you are looking at Ghana and you look at the macroeconomic environment, it's stable, it's steady. Exchange rate at around 10 to 12. Is it a sustainable exchange rate, or should we be looking a little bit higher? It all depends upon what we use the current stability for. And all the rules, it's not either market or intervention. The city is where it is because the central bank aggressively intervenes to maintain it there. But to me, what we need most are strong people. The rules that are made. We had a rule about fiscal discipline, but when the time came and wanted to put on the brakes, they say, no, you can't put on the brakes. I'm heartened that we have strong, and I use a strong men, not in a derogatory sense, but strong men in the shape of people like Abner Amwa, who will not bend to political wishes. And that's what we want. If we all need to put together guardrails. You know what guardrails are? Yes. Rules and sanctions. When you are the Minister for Finance and you are supposed to transfer 5% of tax revenue to the district, you transfer it. It's not your money. You transfer it. 2007, we're thinking about municipal bonds. The district assemblies can use their inflow from the district assembly common fund to float bonds on the stock exchange to do roads, the things that are needed around them. But to do that, we need to move and elect the district chief executives politically so that they are there. You go and borrow today, tomorrow the guy has not been sacked by the president. So we need guardrails to guard all of us. And we can do that. The Minister for Finance says, okay, I don't like mechanistic things. I'm going to have this primary reserve at this level. No. Don't let us do that. If you can use inflation, how long does it take to grow rice? 6 months, 3 months, maize? Have inflation. Put 2-3 billion into it, and we have the maize. Within 6 months, the goods come onto the market and absorbs the money. So I'm happy that we are getting out of the IMF rules and regulations. IMF has never developed any country. They are there to make sure that when we go and borrow, and I remember 2007 when we were borrowing, Dr. Paul Akwe's friend, who was on the other side, said, I hope you Africans are not coming to the Eurobond to spoil it. You come and borrow tomorrow, say you cannot repay. And that's what happened. But there, they have the IMF, the World Bank. You borrow. In the olden days, you go bankrupt. You are a banker, you lend to me, you didn't do your due diligence. Bankrupt. What is bankrupt? Banca ruptare. They break your bench when you come. You can't pay. They break your bench. You are gone. Now, we borrow, Eurobond, we can't pay. IMF, World Bank, they sit on our necks, give us first aid until we repay. Mm-hmm. Let's have the same locally, so that when we have our funds, and you go and borrow, you are not repaying, we put you in cells, so that you are not there to spoil the market again. So it all depends upon the men and women we put in charge. And they will say, no, we are not doing this. They say, okay, you are sacked. Go home. But if we don't do that, then we are in trouble.
All right. Let me bring in the man in charge. What policies and regulations are we going to see over the next 12 to 24 months to help unlock the markets and also address some of the concerns raised by Mr. Wua as well as Mr. Pieni?
Okay, so let me start from the latter and I come to the first. And it's precisely the point that we're addressing, which is the rules that are being put in place that have to be predictable, they have to be consistent, and they have to send the right signal, not only to market players, but even within government, that this is a new order. Gone are the days where people just spend money anyhow, people borrow money anyhow, and use it for projects that are not budgeted, are not properly costed, or not properly utilized. A lot of the work being done now is precisely to try and close these gaps and close these leakages. And if we have to spend, we are spending in the right places. And even if you have to make some sort of support to Ghanaians it's carefully calibrated. So for example, John's point about the fuel prices, we did not take the 1 or 2 Ghana cedi off the taxes. It was taken off the industry margins and levies. So the tax handles still stay the same. It is rather the industry margins that was taken off. And again, if you recognize, we actually gave a bit more on diesel than on petrol. For a very simple reason, diesel has a much bigger inflationary impact than petrol because that's what people use to bring food, the big trucks and all of that from, the hinterlands and all of that. And that is what actually helped anchor the inflation expectations. So if you had seen some of the projections going back in April, March, when the whole conflict started and all of that, but for some of these interventions, inflation currently, the 4.6 would have been a little bit higher than where we are now. So the fiscals and the tax handles are being protected in that sense.
But there's still a trade-off, isn't it?
There's a trade-off as in when it comes to what the regulatory institutions and what they have to do need to do. There are also some issues that they need to address there. But the point really is that whatever you're giving away, for example, of the petrol or the diesel price, it is not at the expense of your tax handles. That is an important point to make. Again, also the point on, for example, the allocations to the other funds, like the District Assembly's Common Fund. Mr. Pianim is very right that in the past, the money was going. And for a long time, sometimes you have to get to the third quarter before you get first quarter DACF releases being made. Mm-hmm. That is no longer the case. As I speak, you do have close to last year, by the end you got to the third quarter, over 80% of the allocations to the DACF had been made. And by the end of the fiscal year, if you look at what we said we will give them, all the transfers had been made to them. Same with the NHIA and same with the other statutory funds. Right. So you do have actually a lot happening, which is to say these are things we should have been doing anyway, that we had not been doing, and now trying to institutionalize and with the right leadership, pushing to ensure that you make things, or take the right decisions that is in the interest of the country and not driven necessarily by the politics. And then the point you asked me on, sort of what you're doing to anchor all of these things. On inflation expectations, like the governor said, we have no reason not to think that you would not be within the band. So the band is 6 to 10%. That is what we have signaled to the market. And that is what also will feed into some of the monetary aggregates, how you price loans, the policy rate, and all of those things. With what you see over the medium term, and even with an escalation of the further conflict in the Middle East and all of that, the measures that have been taken now have given us quite a lot of good grounding to anchor inflation expectations going into year. And that, for me, is the clearest confidence and signal that we can send to the market. It's the same thing with the exchange rate, where, yes, you've had a bit of support on the external side with the gold prices and all of that. But if you had not even done some of the hard reforms like with GANRAP and Gold Board and all these things, I doubt that you would have actually had the windfall cascade or pass through to the economy at the levels that we currently are seeing. And what that would have meant, more or less, would have been having to go back to the market to the borrow. But today, you don't need to go to borrow Eurobonds. Ghana is in a relatively comfortable position where my minister has said that we are not in a hurry to go borrow from the international capital market. We want to do more domestic. We want to be able to work with the bankers and the treasurers in the room here. I've now showed a very interesting chart. You're doing only less than 2% corporate. Mm-hmm. The macro environment is stable. I would love to see that number go up because government says that the treasury bills and the rates are where they are and they are going to be at that level for some time to come. Right. So how do we now engineer or shift that to get more private sector businesses coming in, and that liquidity or debt that they raise goes to expand their output And at the end of the day, they can hire more people. And for me as a fiscal man, I can get more taxes. That is really what, the end game is.
Okay. Our time, we're far behind time, but so we're wrapping up. On the question you were asking on how we intend to shape the market so we can see more long-term borrowing. Quickly, in 30 seconds, from your side, how you intend to do that. Then I'll come to Mr. Uwa and Mr. Pienim on other matters.
So I think from the fiscal side, it's to get the rates at the levels that are comfortable. So from the macro fiscal aggregates, the policy rates, the inflation and all the things that we need to maintain a stable macro, we will do that, and we can give market players the assurance that the government is not going to slip on that. Then beyond that, some of the issuances that we do, for example, we have signaled the infrastructure bond. There's opportunities for some green bonds and other new instruments beyond your conventional 91-day, 365-day. There's appetite for new forms of instrument that we can work with the capital markets to actually issue off the back of the sovereign. But this is, again, all be done in the context of your fiscal rules that you have set. So you're not going to be doing this, just borrow all over the place, and at the end of the day, mismanage the fiscals, and then you have to do another round of restructuring. That is not what we're trying to do.
All right. Thank you, Dr. Theo. Let me come to you, Mr. We are on the sectors that you think currently, based on the developments we are seeing, are best positioned to go ahead to raise the debt capital?
Yeah, the key sectors, if you look at the disaggregation of the GDP, you see where the growth is happening. The service we see in the ICT, we are seeing about 25% growth in that area. Transport and logistics is another area of interest. Again, mining, export-oriented businesses is another key sector that I believe can be attractive to the debt capital market. But as has been said, it is time for us to also test issuers within the infrastructure area. With the success of the sovereign issuance, the 7-year, which was more or less oversubscribed, it tells us that there's a sense of appetite. And if we get a credible issuer within the infrastructure space, I would prefer, from a private sector perspective first, before a government issuance, other municipal bonds or infrastructure bonds, that a private operator, private sector issuer first. So sectors are important, but the driver of the debt capital market is basically not driven mainly by that. It's driven primarily by the credibility of the issuer, the transparency around the issuance, the governance structures around it, the disclosures. So my view is that is where I would like SEC and GSC to spend a lot more time developing. We do not want a situation where the market is now recovered and we're now looking at growth, and then you see a tank because a certain issuer just came and threw some sand in our gari. We want to have this growth trajectory sustained. How we sustain it is properly vet the issuing corporates in a manner that they come in and the investor population is more interested. You have the pension funds, the banks are there, you have the insurance companies. Liquidity is there, but liquidity is not just saying, come. Liquidity will go where there's credibility and governance structures are right. And I believe that aside the structures, we need that section to function properly. And that is where SEC and GSC come in.
All right, thank you. Now, my final question, which is going to all three of you, is if you are to advise somebody, one piece of advice to an issuer who is considering going on the market, Mr. Pienim, you are the guru of investments. What would you tell this person in line of everything that is happening?
Be honest. Have the right numbers only one figure for everybody, like Abner said. And know that you are going to borrow, you will repay. Honesty, good management, and making sure that whatever you are doing, you are going to have a good succession plan, like Fidelity Bank has made, done the transition from the two founders of the bank to a new generation, then you'll be able to pay. So honesty, all of us Ghanaians, it's our responsibility to make sure. And to me, food security. We have to feed ourselves. So the MPRA, all the regulators have a growth and employment generation outlook mentality. The billions of dollars we need to invest to create new jobs for the young people who are coming. And remember, you either create jobs for them so they become forces for development, or you leave them and they become destroyers. They'll be bandits. They'll be armed robbers. They will not be contributing to grow. So all of us, the most important thing, go into the right sectors and then be honest. And if NPRA and all of you don't have an innovative mind, young graduates giving capital will use irrigation to be able to feed us. And let's remember, if the Galamsey continues, there's nothing you will do. You won't have water. You are not rich enough to import avian water to drink. And the genetic made of our women are being destroyed. So let's focus on that, clean it up. The next war will be fought over water, where the water is. And when the West move in, they will push us to the arid areas. Now that the weather is changing in Europe, they will give us free visas to go there while they come and stay here. So you and I, let's do the right thing and be strong. And I think we'll maintain this macroeconomic stability and move it forward. Otherwise, in 10 years' time, I'm gone. You and your children are here. Make sure that this place we have called Ghana is made safe and productive for us. And our young women and men stay here to work instead of running away, walking to other countries to add value to our raw materials in countries where nobody wants them.
Right. Thank you, Mr. Pienim. Mr. Owa, one piece of advice.
Issuer?
Yes.
I would say preparedness. You know, preparation is everything. If you are, you want to be an attractive issuer in the debt capital markets, you don't come because you need liquidity like tomorrow. You plan to access the market. How you plan is to get yourself ready as an issuer before the criticality of liquidity demands kick in. So in just one point, I would say that issuers should get themselves fund ready, documentation that is needed, and whatever, as Mr. Pienim said, transparency in the issuance. So the offer info that is released, the disclosures should not just be complying with disclosures that SEC says you should comply. Right. That is the minimum compliance in terms of disclosure. You have to go beyond it, and let the investor population know that you want to open up as much as possible. That gives you credibility in the issuance process. So preparation, good preparation, and also transparency in the issuance.
Thank you, Mr. Wa. Let's talk to you.
Yeah, so in addition to the transparency and the honesty that both gentlemen have said, I think for me, from a government side, it's really the issue of credible policy and predictable policy. And I want to, again, give the assurance that government is committed to these two: policy that is credible and policy that is predictable. The next phase of the work and the reform agenda, as you've seen, perhaps in some of the news, is what is being called the new economy. And it's precisely trying to build on the reforms and the stability to do three things. The first thing is growth, but growth that is more broad and has breadth. Also linked to jobs, and then productivity and innovation. And this is really where we are trying to push towards. And part of that is the question of the food security. There's a big emphasis on agriculture and agri-mechanization, not cutlass and whole farming, but proper commercial scale agriculture and all the logistics that are needed to unlock, these value chains. That is all being addressed. For our friends in the room here, I think what I want you to live with is the assurance that the government is committed to maintaining a stable macro environment. And what you have seen over the last 18 months is not a flash in the pan. This is going to be the new normal going forward. And we want to work with you now to get more capital going into the businesses, going into the SMEs, going into the large corporate, so that they can employ more and I can go and collect my taxes to build your roads for you.
Right. Thank you very much, gentlemen. But we've opened the floor for questions which have come in, so I'll please say that, give us a few minutes so you can answer some of them. This one is from Stanley. This question is directed to you, Dr. Theo. He's asking whether the Ministry of Finance is ready to demonstrate strength by focusing on raising capital domestically to deepen the debt market and not returning to the Eurobond market.
I think that one is, I've addressed that, and my minister has also indicated it very clearly. The Eurobond market for the next few years is out of the equation. He said that we are not in a hurry, I'm quoting specifically, to go to the international capital market. There is enough liquidity within the system here, which we can raise, but it also has to be priced right. So you would see, again, let me borrow Abene's chart. You saw some rejections and all of that there. It's a question of pricing. If the pricing is right, you would go for that. So we want to do more local issuance, but you back that up with a credible plan that says that your fiscal numbers, I can rely on them. If you tell me that your debt is at a certain level, if you tell me that you're raising this much revenue, as an investor, I can look at that and say, yes, sure, I'm happy to give my my money to the sovereign. Yeah. And then, like I indicated, beyond just the normal treasuries, there's upcoming opportunities in the infrastructure bonds to get our pension funds to use more of the capital they've got to support, other real sectors of the economy. So that is quite clear from where we sit.
Okay. This is for you, Mr. Ewa. In vetting the issuers and issue to ensure investors are protected, what will you suggest in terms of independent assessment of issuers before listing? Do you want me to go over again? Well, this gentleman says, in vetting the issuers and the issue to ensure investors are protected, what will you suggest in terms of independent assessment of issuers before they list?
Independence, I believe the entire process of vetting the issuer starts from the approval process. Was it from the stock exchange? Yes. So before an issuer comes to the market, issuer would have gone through a process, maybe going through an advisory company to understand exactly the market, what their needs are, and the use of proceeds, and all the benchmarks that the issuing would have demonstrated, the issuer would have demonstrated. So the documentation, as we see, if an issuer issues the information memorandum, as we call it, the benchmarks and the thresholds of the issue are all spelled out in the memorandum. And in that case, the investor population or the investors review these documents as to whether we would need an independent house or an independent agent to give a sense of credibility of the issuer. I'm not sure. I don't know whether we even have that. Do we have that? Oh, you do? Okay, all right. So then I think Abena will be able to help.
If we can kindly help with the microphone, please.
Thank you very
John.
much. So before an issuer comes to market, they must hire independent firms comprising accounting firms, lawyers, financial advisors, many of them in this room, and even rating agencies who work with them to put everything together, make comments on their historical financial statements, assess their projections, etc. So the regulators, GSE and SEC, we don't organize the firms. It's the advisors, the investment banks in this room, the lawyers, the accounting firms, etc., who do all that work independently. So you can't even use your existing auditor to comment on your financials. You must get someone separate from you. And they are the ones who put together the documentation, and then the investors like Nana Safo, etc., can look at. We at the regulators' side make sure that the information you've put out meets the minimum information requirements. Thank you.
Thank you very much, Abena, for that kind intervention. Final question to Mr. Pianim, then we wrap up. This person is saying, is heavy domestic sovereign borrowing the reason Ghana's corporate DCM market has never really developed? And what do we intend to do to deal with this, if that's the case?
I think that when we begin to look at the domestic debt market as the source for growing our economy, then we'll set up and develop all the structures that are needed for us to make sure that the funds themselves grow. In terms of pension funds, I think we have about 80 billion Ghana cedis in pension funds accumulated now. It's increasing probably at a rate from the earnings and then the new ones that are added to it, about 1.3 billion. So we have about 15 to 20 billion annually coming in pension funds. And if you take tier one, SNIT, for example, the government should go away from the old method of not paying their SNIT contributions. They should be like me, a businessman, pay a penalty. They go and write it off. So if we strengthen the structure, the sources, insurance coming in, make sure that all these financial institutions are significantly owned, like Fidelity Bank, by Ghanaians, then we are on the right path, and then we will be dancing to our inner tune, not to others' tune.
Right. Thank you very much, gentlemen. Please let's give a round of applause to the panel. Mr. Kwame Pianim, thank you very much. Dr. Theo Echampong, thank you very much. And Mr. John Ewa, thank you very much. Thank you. Thank you.
Thank you very much. Let's put our hands together, please. And they will have a picture together. Thank you very much. And this has been a very captivating conversation with a lot to take away on the macro environment, sustaining the gains, and also improving on what we have currently, and all the issues that have been brought to the fore, and the various roles that all the institutions herein represented would have to play to sustain and improve on the gains that we have made as a country, and how that would also influence the next phase of our development agenda beyond the stability that has been achieved. Thank you very much. we would move on to our next panel. And Vivian, you would have to stay around a little bit more as we get ready into our next panel. But a quick reminder, this is the first edition of Fidelity Bank's Debt Capital Markets Conference. Lower rates, high opportunity, unlocking growth through the debt capital markets. And we're live on Joy 99.7 FM and also the bank's social media handles. And please, there's coffee served outside at the foyer. You can grab it and come and sit down and listen to the conversation for the next phase as we're going into it right now. I promise you that you will be in a good place when you get the coffee. So make some time, go out there and grab it and come in and come and sit and let's have the conversation going. So we're not having the coffee break as is on the program, but please make some time. You can grab a cup of coffee and come in, take a seat. The conversation continues. Our next panel is on the topic navigating the debt capital markets, regulatory environment, issuer testimonials, and evolving investor priorities. Please, I'll kindly urge that for those of us who are stepping out to get a cup of coffee, come in. We could do it one after the other so we don't obstruct the conversation. Thank you. We get ready for our next panel, ladies and gentlemen. The next panel, as I did indicate, is on the theme or the topic, navigating the debt capital markets, regulatory environment, issuer testimonials, and evolving investor priorities here at Fidelity Bank's Debt Capital Market Conference on lower rates, high opportunity, unlocking growth through the debt capital markets. After this very engaging conversation in our first panel, this second panel also promises to be one that would have a lot for us to take away regarding the next phase of our economic development, the role that the debt capital market will and must play, and then also the regulatory environment and the evolving investor priorities. Please, let's take our seats now. Thank you very much. Shall we kindly take our seats? Ladies and gentlemen, please, let's take our seats so we go on to the next panel. Thank you very much. Thank you. Let's take our seats now. Thank you. The next panel would have first Mr. Jacob Adu, Dr. Jacob Adu. Dr. Jacob Adu is an accounting and finance professional. Ladies and gentlemen, please, let's kindly take our seats. Thank you very much. Distinguished ladies and gentlemen, we haven't taken a purgative this morning. Let's be at the right place. Thank you. Right on. Dr. Jacob Adu is an accounting and finance professional with extensive knowledge and experience in corporate finance, capital market, and securities market regulation. As Director of Corporate Finance, he provides leadership for regulatory oversight of public offerings, mergers and acquisitions, financial reporting, and corporate governance in compliance with securities laws to ensure integrity of the market. His knowledge and experience in the securities market enable him to play a significant role in development market rules for regulation and development of the securities industry in Ghana and in the sub-region. He mentors and leads a team of professionals to advance regulatory innovation and efficiency. It is also one that he looks at very carefully, committed to building a resilient capital market that supports economic growth and protects investors. He serves on the technical committees of the Financial Stability Council, Ghana, and West African Securities Regulators Association, the body responsible for overseeing the integration of the West Africa capital markets. Dr. Jacob Edu is a chartered accountant and a member of the Institute of Chartered Accountants, Ghana. Please, ladies and gentlemen, let's put our hands together as we make welcome. Dr. Edu, thank you very much. Also, next is Mrs. Lavena Opong Kweno. Is a capital markets professional with over a decade of experience at the heart of Ghana's fixed income market development. Her work at the Ghana Stock Exchange spans market development and innovation, including sustainable finance, commercial paper, and the frameworks and infrastructure that underpin deeper and more resilient fixed income markets. Her career has brought her into collaboration with regulators, financial institutions, investors, and international partners, giving her a distinctive perspective on what it takes to move markets from ideas and policy to practical implementation. Lavena is an alumna of the IFC Milken Institute Capital Markets Program at Georgetown University, USA, and holds an MSc in Accounting and Finance from the University of Northampton in the UK. She also holds the CIMA Advanced Diploma in Management Accounting and the ACI Dealing Certificate, and is a member of the ACI Financial Market Association. At the center of her work is a conviction that Africa's capital markets can do more. Ladies and gentlemen, please help me make welcome Mrs. Lavena Opong Kweno. Let's put our hands together. Thank you very much. Next is Nana Osei Ajiman Boachi, in charge of standards and compliance at the National Pensions Regulatory Authority. He's an accomplished finance, governance, and regulatory professional with over 18 years of progressive experience spanning both the public and private sectors, a member of the Association of Chartered Certified Accountants and Institute of Chartered Accountants, Ghana. Beyond his regulatory role, Mr. Boachi is a partner of Internalysis Consult, a management consultancy providing financial advisory, internal audit, business process improvement, and financial controller services to SMEs. Ladies and gentlemen, please help me make welcome Nana Osei Ajiman Boachi. Thank you very much. Next, joining us, Daisy Ejay Boydi is Chief Finance Officer, the Shago Ghana Savings and Loans PLC. Is a seasoned finance executive and chartered accountant with extensive experience across financial services, including banking, insurance, pensions, audit, and assurance. She currently serves as the Chief Finance Officer of Shago Ghana Savings and Loans PLC. In this role, Daisy leads financial strategy and drives balance sheet optimization, overseeing capital, liquidity, treasury, performance, and financial risk management. Her role provides direct exposure to funding strategy, capital allocation, and the evolving financial needs of the business environment with a focus on sustainable value creation. Known for combining technical debt with strong commercial judgment, Daisy is a strategic business partner committed to transforming financial insight into sustainable value, strengthening institutional resilience, and also supporting responsible long-term growth. Ladies and gentlemen, please help me make welcome the Chief Finance Officer, Shago Ghana Savings and Loans, Mrs. Daisy Ejay Boydi. Let's put our hands together. Let's put our hands together for her, please. Thank you. Next to join the panel is Nana Safo, CEO, Bora Capital Advisors. Nana is the founder and chief executive of the Bora Capital Advisors. He has over 20 years experience in the investment banking industry in Ghana and has worked on several major transactions in Ghana and the West African sub-region. Prior to founding Bora Capital, Nana was the CEO of Fidelity Securities and head of investment banking within the Fidelity Group for over 5 years. So he is back home. Nana has an MBA from Carlson School of Management, University of Minnesota in the USA, and also BA Economics and Computer Science from the University of Ghana, and also a chartered banker. Ladies and gentlemen, please, let's put our hands together for Nana Safo, CEO, Bora Capital Advisors. Thank you, Nana. Thank you very much. Also next is Boaz Asari. Is an investment professional with over 9 years of experience in asset management across traditional and alternative debt and equity strategies. He currently serves as portfolio manager of the Platinum Debt Income Fund, a mutual fund channeling local pension capital into listed and unlisted debt opportunities. Under his leadership, the fund has raised over 300 million Ghana cedis from domestic institutional investors and high net worth individuals and deployed more than 200 million Ghana cedis across transportation, financial services, mining services, and hospitality. Boaz has structured and executed more than 550 million Ghana cedis in traditional and alternative capital transactions spanning financial services, FMCG, healthcare, fintech, energy, and infrastructure. He holds a Bachelor of Arts in Economics and Mathematics from the University of Ghana. Ladies and gentlemen, please help me make welcome Mr. Boaz Asari, Managing Director, Credit and Research. Let's put our hands together. Thank you. So, as I say that if the music is nice, we have it twice. If the moderator is good, we'd have her twice as well. Is it not? Ladies and gentlemen, please, let's put our hands together for celebrated Vivian Kai Loco to take the next panel, the second again, as we get ready for the final panel. Please, and pay attention to the QR code as well. You can scan it. And when it's time for the questions, kindly put the questions in. Thank you.
Thank you again, Alfred, and good morning again to all of us. Good morning. Oh, good morning. Are we happy to be here? Okay, are we excited for the next conversation? Okay, so this is a powerful panel and very loaded, and we'll try and get as much from all of them within the next 45 minutes. So I'll make it quick and snappy. Please, apologies for that. We want to hear from all of you. So let me go straight to the first question, and I'm going to give it to Mr. Jacob Adu, the regulator. Now, it's obvious that we all want to go to the capital market, but from your office, what are the key requirements we need to get into the market?
Right, thank you, Vivian. I think it's also appropriate to congratulate Fidelity Bank, a bank advocating for the expansion of the capital market, saying effectively, I'm not the only one who can give you money. Look for other people to come and compete with me. And that shows how progressive the bank has become.
I think they deserve a round of applause.
So to come to the capital market, it's a decision that the company must make. And you know, the board is the people in charge of these companies. So the board must resolve that this is what we want to do. After they've considered their circumstances, what they want to do, and how much they need to do with what they have decided. Then get the shareholders also to approve. You see, when you go to the market and borrow money, it has implication for shareholders. If something goes wrong, shareholders lose everything. And so you get your director's approval, you get your shareholders' approval. Then you also look for professional advisors, as had been mentioned. These are licensed people who have been certified by the SEC to do this kind of business. You don't go and look for some roadside person who claims to be a financial advisor and not licensed. Then you come to SEC, we tell you, go back and look for these people. So get those people to help you put the documents together. Then you can come to the SEC for the necessary vetting. If that's fine, then you are allowed to go to market and raise the funds that you require.
So that they come in, they've ticked all these boxes you say they should. They've started the process. What are the common mistakes you see that people commit, and how can they avoid that?
Yes, sometimes people want to raise bonds and they will say, you want to use it for general operations. What is general operations? You have to be specific.
Okay.
Because people want to monitor what they're going to use the money for, and even assess whether that activity can generate that kind of money that we needed to repay the loan. So if you say general operations, that is not acceptable, and it's too vague. Be specific. And also, as I said, use certified, licensed professional advisors. Not anybody who claims to be knowledgeable in finance has been accredited to do so. So these are some of the things, major things that they will do. And of course, you can raise funds as a company which is incorporated under our laws.
Okay.
So you ought to have been incorporated, registered by the Office of Registrar General's Department. You must be filing your returns. This time, if you come to SEC, you have an ORC person on our board. If you come and she checks a record and you don't file your returns, you'll be sent back to go and straighten up. And not even only companies, statutory bodies, entities that are set up by acts of parliament are also eligible to raise money.
Right.
You only want to be sure that your identity is legal.
All right, thank you, sir. Let me go to the NPRA. I mean, your funds represent a lot of pension funds, but what goes into your assessment of corporate debt opportunities? Mr. Boache.
Okay, thank you, Vivian, and good morning. Yes, as we all know, the NPRA has the sole object of, ensuring that there's effective administration of pension schemes. And by that, the fundamental concept here is, assessing the risk and de-risking the industry. So basically, our job is cut out for us through our mandates. That is given to us by the National Pensions Act 2008, Act 766, specifically under Section 7. And within this act, it's also spells out the exact permissible investments. And as you said, corporate debts are also part of it. And other government issuances with government securities, equities, ordinary shares, and many more are parts. But the authority also has its guidelines that was mandated, that it has a mandate to, provide guidelines within this Section 7. And it requires, it also have corporate debt securities, which has a ceiling of about 35%. Okay. Yeah, limits. And as at now, patronage with that corporate debt securities lies somewhere around, let's say, about 2%.
Only?
Yes.
So there's room for...
Yes, so there's room for, but that's of governments of Ghana securities, which also has a ceiling of about 75%. We are currently the industry is doing about 64%. But historically, it has been within the threshold of 75 to 78%. Okay. But within the past, let's say, 1 or 2 years after the DDEP, definitely, we've seen that shift from 75% which was the ceiling, to somewhere around 64%. And the gainers are not actually corporate debts. They are actually equities, which is doing about 12% from a traditional 5%.
Okay.
And also other instruments like bank securities, which is also permitted under our permissible investments. That one too has climbed up from about 8% to somewhere around 14 to 15%, and that is doing well. So basically, that's the appetite for the investors within the pensions industry.
Right. From what you're saying, you have a large pool, and you would want people to come in there. But what structures should issuers put in place so they can tap into your funds?
Okay, with the pensions industry, as I rightly said, the mandate is clear, and our objective is risk, and de-risking. So I will say issuers should focus on bankability of their instruments, their securities, and the securities should be actually well structured. And as the previous panelist said, Mr. Ewa said, vetting of these securities is quite, required. And one of our requirements from investors and trustees is also to, conduct a thorough due diligence on our issuers before we give them the approval, especially when it relates to alternative investments, which are quite non-standardized and exotic.
Okay.
Yeah.
Right. Let me come to the Ghana Stock Exchange. Lavina, when you were called, everybody was giving you funds, meaning you have a lot to say. But it's obvious we are all pushing towards going on the market. Now the activity is not as high as we want to see it. What challenges is leading to this limitation, and how can we deal with that?
Okay. So with the corporate bond markets especially, I think it's because of the limited liquidity in the market, and that investors who currently hold the corporate bonds hold it to maturity. And if we say there's limited liquidity, there is not, I remember, I think when, I don't know, it was John who said that we need to create an opportunity for investors to exit. So they hold to maturity. Once you want to sell or buy, you need to wait because you need to get the signal that there's another person who wants to. But there's something that's called the market making. If you give an opportunity for specific players in the market, if I say players, I'm talking about the traders. If you give them specific role to do to make markets, so then at any point in time, they are selling and then they are buying. If an investor wants to probably exit the market, that investor doesn't have to wait for another investor. They can just sell to the trader, and then the trader can probably use it, and then when an investor, so at any point in time, there's a buy and then there's a sell. So what is contributing to the limited liquidity in our market is because of market making, and that is what the GSE and then the Securities and Exchange Commission is actually working on, bringing up the market making rules to make sure that at any point in time, there's activity not only in the government security, but also in the corporate bond market to also give a signal to investors that even if they come in at this point, they can always exit, and then use that money or that investment that they have to invest in probably another security also in the corporate bond market.
So what interventions are you putting in place to increase the activity on the corporate debt market?
Okay, so one of the things we are doing, as I earlier indicated, is bringing up the market making rules, which is going to help with the activity in the corporate bond market. Now, the other thing is we have a business development team, which is led by the managing director of the Ghana Stock Exchange. And we are seeing the results of that as having even Petrosol come to the market, moving from institution to institution to let them appreciate the importance of raising capital on the corporate debt market. That's one of the initiatives that the GSE has been doing over the years. We've had results, and we are actually going to see more in the next probably 12 to 24 months. So these are some of the things we are doing.
All right. Let me bring in somebody who has tried and tested the system. The three of you have spoken so nicely about Madame Daisy Ajay-Boedi of Leshego, you have successfully gotten onto the market. I remember when you guys got in there years ago. What were some of the surprises you experienced boarding and some of the challenges and how you dealt with it?
Certainly. Thank you and good morning once again. So challenges, we've walked that path before, and top of mind really is to say, how fast do we get the regulatory approvals? I remember we started with a node program of about 100 million, that's somewhere in 2025. In 2028, we went back to increase the limits to 300 million. 2022, we had that approval. 2018, sorry, we had that approval. Then in 2023, we went back again to increase it from the 300 million to the current 500 million. And after going through our various processes between our primary regulator and the SEC GSC, it took on average about 16 months to have the final green light to go to market. So that certainly is a bit too much time. So working through, and unfortunately you can't necessarily pinpoint or predict how long the regulators are going to take. So you need to make sure that you have the right partners with you. We've mentioned having the arrangers to the trustees, to legal, to accountants, have the right people walking that journey with you. It really makes things easier. And we have been privileged to work with Fidelity as trustees. They've been phenomenal, so they've supported us quite tremendously on the journey. Another surprise too is that it certainly goes beyond money, just raising funds. You are dealing with investor confidence, you are dealing with perception, and coming from a savings and loans industry with a cleanup and a number of hurdles that the market has really gone through, it has dealt a blow to the image people have of us standing out looking into the savings and loan sector. So the opportunity corporate bonds actually offer us is to get closer to the institutional investors, the pension funds, the insurance companies, asset managers, and even through reporting, having facts behind the figures, the various forums that we have to engage with our investors, we're able to demonstrate the amazing thing we are doing as Leshego better, and that supports the confidence that they actually have in us as an institution. So we've been on the market a couple of times. We've raised cumulatively over 620 million from the bond market. And we expect that going forward, it will still continue to be a strategic part of our funding pool, given the kind of assets that we create.
Tell us some of the benefits you've derived from this move. I'm sure a lot of people want to do it, but they're asking themselves, at the end of the day, what comes out of it?
So a lot of benefits, but certainly being a finance person, there's a tremendous benefits that comes with having a very diversified and sustainable funding pool. So for us, some of the loans we create are long-tenured in nature. So having these longer-tenured bonds sort of helps you on the asset liability management side. It also supports you on the liquidity side as well, and making sure that you're able to honor your obligations. And also strategically fund your growth ambitions as an institution. Another benefit to us, I said, we are now closer to the institutional investors. So beyond just raising capital, there are a number of strategic partners that have been born out of just having to raise funds. So even beyond having them as investors on our corporate bonds, we've unlocked new opportunities where we can partner and push our products and really develop mutually beneficial relationships at the end of the day.
Right. Thank you. Let me bring in the institutional investors, Dana Safwo as well as Boaz Asari. Mr. Pienim, during the first panel, spoke about being transparent, the need for governance, to be adhered to and all that. How important is this in getting onto the markets?
Well, it's very, very important. I will never do a deal or a transaction with any person that I cannot trust. And for me, it is a very fundamental point that usually I'll put our investment committee in a room, I'll send them to a prospective issuer and tell me, can you really trust this person? Remember, we are managing funds We go there as institutional investors. But bottom line, it is that nurse in Savalungu or Tamale whose life investment or pension that you are holding as the expert advisor on it. And you are looking at this rich man driving a very nice car, and asking yourself, if you give this man 20 million today to do a factory, will he not turn around and buy a car or a house in Dubai for his girlfriend instead of actually doing that project? And so sometimes when we are analyzing a company, these are the deep questions that, can I trust this man to be around looking after the business in 5 years when the big check hits the bank account? And when I am assured that he will be around, then we can. So it has to be transparent. There are some people, you go in and say that you are an institutional investor, you want to go through their board papers. You just want to read the board papers. You sign all the non-disclosure, you won't take it anywhere. They will tell you that, you know what, we are going to the bank. The bank says they will give us the money in 2 weeks. You are saying 4 months. It's okay. And that's it, because he cannot trust you, and you cannot even trust the board papers that you are saying. And as Mr. PNU said, you cannot trust even the accounts that you are looking at, because the accounts that has been given to you and you are analyzing, if you ask for their bank statement and you look at the sales they've made and the one they've reported to the GRA, there's a big disconnect. When you look for the CEO, the founder's business, you find out that half the sales of that company is going through his own personal account.
Yes.
Which means you are more likely not to get the money when he becomes even bigger. So it's very, very important that you should understand that this business, that you, if you want to go to the next scale, let me give you an example. When Casapreco wanted to come to the bond market to do their first one, and we went into the room, investors are there, they talked, and then I asked the young man, Richard, I need to see you in a room, because this question, I can't ask it in front of everyone. When I pushed Richard into the room, I looked at him and said, your dad built a very good business. Are you telling me that you will not disgrace him when you come to the market? And he was shaking. But the answer he gave me that day is why they were able to do the first corporate bond. Because the market rejected their first corporate bond by not subscribing. When the prospectus came out, they were not getting people. But the answer he gave was enough for us to say, go on, but we are putting this clause that if you want to expand, you raise equity, not debt. And he shook hands on it. Now he's come and done an IPO and oversubscribed. So that trust is extremely important. If you want to come to the market, we are willing to partner with anyone with money. But please come with clean hands. Don't come and try and take people's money because there's liquidity. That we will not. Thank you.
Thank you. Come with clean hands. What should they disclose to you so they can stay and get the money? Yours.
All right, thank you. I'm very much aligned with Nana Safo in terms of his thoughts, in terms of coming with clean hands. But particularly in terms of disclosures, the main thing that we are trying to understand, so maybe I'll give an idea of what the principle is behind disclosure. At the end of the day, any investor who sees an opportunity wants to make sure that they understand the kind of risks that they are taking. Because at the end of the day, for the debt investor, his opportunity or his upside is capped at the interest rate that is promised to him. But for you, the entrepreneur, when things go well, you make as much money, but the amount you might agree to pay me is what I get. But when things happen that don't go well, I get hit on the downside. So at the end of the day, for me as a debt investor, I want to protect my downside. So I want to understand what kind of risks, what could change if things don't go well. A lot of the time, the entrepreneurs come telling you, oh, we've done this great thing, and we are happy about it, right? But when things change, what happens to the cash flow that are supposed to be used to service that debt? So it is important that from your financial statement, from things pertaining to legal due diligence done by lawyers, from things pertaining to who's on the board, how things are run, management decisions, strategy, business plans, everything that gives the debt investor an understanding of that specific risk is what is needed. So a lot of the times when a lot of questions are being asked is because an interesting opportunity has come to you. You need to understand it, consume it, and go back to the same pension trustees who gave you a mandate to invest their money and explain to them, this is why I'm doing A, B, C, D. Right? So the key thing for us is to understand. So to the extent that we as investors need to understand the opportunity, need to understand the risks, the downside, I wouldn't say there's much of a limit in terms of what can be disclosed, but fundamentally, there are the key things like your financial statement and the likes that I've mentioned. But the principle there is that we need to understand the risks to protect our downside and to be comfortable that even when the economy turns slightly, we don't have a case where we start to lose our money and people start to panic. So basically, that's just a fair idea of things.
Okay. I'll start with the two of you as investors and come back down the lane. I mean, the person has declared everything, you see everything is fine and all that. What will push you to walk away from a transaction at the end of the day?
I think the first thing is when you bring a forecast that are not justifiable. And sometimes in people's estimation of coming to the market, he wants some big money, and for that reason, he brings forecasts or projections that you know that what is in there, you cannot, the assumptions don't make sense. When I see that, I'm likely to walk away. If your assumptions don't make sense, it is okay for Petrosol to come and say, and we participated in Petrosol, to say that if I get interest rate in the region of 17%, I can put more filling stations around East Legon area where volume is high, because already I've covered the rest of Ghana, most part of Ghana. But there are some heavy areas, and I need an interest rate not more than 17%. And I'm happy to participate in that than somebody who comes in, has never done 10% even margin. Then all of a sudden he has a forecast that says that he's going to grow by 35%. Or he's going to make profit of, I look at it and say, Master, you don't understand what you are doing. And if I cannot work with your assumptions, I better walk away.
Okay.
And there are those who will also insist on certain advices.
Okay.
We have some lawyers that we are happy with. We have some accountants that we are happy with. Because they will tell us the truth.
Okay.
They have their reputation. There are some auditors that it's their first time and they are going to make all their money, so they will disclose whatever and walk away. And there are those that we know that at least they will do a good job. Okay. So if you insist on using certain advisors, for instance, we are more likely to walk away.
All right. Okay. Baz, your final thoughts, and then we move down. What will make you walk away?
Okay, I think in terms of the opportunities that we see, the key term there is risk. When I say risk, not in the sense of we not wanting to take risk at all, but risk that hasn't been clearly managed or where there's a clear outlining of how to manage that risk and how to, should I say, quantify and understand that risk. So you see a business, you see all the particular risks that come with that business. But if you realize that you have this particular business, but management is not able to give you a clear idea, management whose business it is not able to give you a clear idea on how to manage those uncertainties. Management is also not accommodative of what you propose to them in terms of how to manage this particular risk that we observe during our assessment of the opportunity. At that point, it becomes difficult, or that point becomes a strong deal breaker for us, where when we outline our risks, we engage our IC, these are the particular risks you see, these are the proposed mitigants. But you engage management, and management thinks maybe it's too much of a constraint for them. Okay. Then it becomes a challenge. Like Nana Safo was saying, in the Casaproque opportunity, there were certain proposals that were made, and they were willing to accept that based on the kind of risks that we're seeing. Okay. So when there are risks that are not properly managed, or there are certain structural protections that are proposed, and management and entrepreneurs are not willing to take on those management of that risk, then it becomes a challenge for us when we have to approve or proceed with that opportunities. Thank you.
Thank you. Daisy, you have seen it all, been there. What advice would you give to somebody who wants to issue? Your final words.
So I'd say do it right and do it well. Because right from the start, the first hurdle is most difficult. But once you cross that, you're transparent, you have the right financial projections, you're using the right partners, you actually use the funds for what you actually went to market to solicit for. The results speak for you, and you tend to add to and boost the confidence that investors have in your business. And in so doing as well, you also open the door for others to walk through. Because at the end of the day, I believe with the work that Shego has done, if another savings and loans company decides to go into the market, they may not necessarily go through the same hoops as we have, because we've sort in the ground somewhat. So I'd say just do it right and do it well. Maintain transparency. If you say it, do it.
Right. Let me come to Nana. What are some of the constraints you guys face in allocating the funds to the market?
Okay. I think this is rightfully for the investors, but let me come in. I'll take it in good faith. It's not really about we allocating, the regulator allocating. It's it's the responsibility of the trustees and investment fund managers to actually make investment decisions. Okay, so the investment fund managers advise on these and give recommendations to the trustees of pension schemes. So in all this, I believe securities and the instruments have to be marketable, because at the end of the day, it's the investors who are going to make those decisions, and if it is going well with the trustee, they will accept. But for the regulator, at the end of the day, our priority is to ensure that, given all the risk that the market takes, at the end of the day, when you go on pensions, I mean, your money should be there. Yeah.
Let me come to Mr. Adu on what we should expect in terms of regulation in the next months or year or two, as we all push for people to come onto the market. any policies and regulations that we should know about?
Well, for now, we are looking at having a specific or dedicated framework for corporate debt issuances. We have some framework we use already, but as we want the market to expand and also be abreast with best international practices, we are working on a dedicated framework that will be guiding bond issuances. We are also looking at automating the process.
Okay.
Yes. Now, what it is the best you can do is an email, attachment to the SEC. But we are looking for a portal where advisors will sit at the office, upload whatever information that SEC requires. We look at them and also communicate our feedback to them to facilitate the process. Leshego has been one of our most compliant issuers.
A round of applause for Leshego.
Yes. I don't remember they giving us any problems at all. Very compliant. And I think the truth must be told. Yes. And so for the delays, you see, for SEC, for instance, Madam Abdan is here. If you want to do a commercial paper, it takes 7 days to be approved. Bond takes between 4 to 6 weeks.
Okay.
And the period you spend putting your documents together, going to Bank of Ghana and all others, that is not at the doorstep of SEC. Those who have worked with us, they can testify that we don't delay their applications. Okay. And so there's the assurance that those who want to come, just get the advisor to work with you and then bring a workable, reliable document that investors will see and accept.
Right, so you've given us some great assurance. Before I come to you, Lavina, then we wrap up. Now, if your car is parked by the roadside, you kindly have to move it from there. We're told the AMA is towing cars by the roadside. So if you're guilty of that, please move your car. Lavina, I'm looking at 5 years, what it will look like if all the things we've said so far are done. Paint a picture of your expectations, if we've all ticked the boxes, and in 5 years, what the corporate debt market will look like from where you sit.
Okay, so you mentioned AMA, so I think I'll use AMA as an example. So in 5 years, we are looking at corporate issuing more innovative products. We have a green and sustainable bond market. The Bank of Ghana has just recently built on its ESG principle and then also launched the sustainable roadmap. SEC has its sustainable guidelines. The market is ready for sustainable bonds. In 5 years, in the next 10 years, I see the market being dynamic. So not just going the traditional Leshego bonds and then Eastway bonds, but then also issuing bonds like the green bonds, the infrastructure bonds, and then also I was reading an article or a report by the OECD, Africa Capital Market Report 2025, and it indicated that only 14 countries out of the 55 or the 54 African countries have issued corporate bonds locally. It means that this problem is actually not a Ghana problem, it's an African problem. Yeah. And what is the solution? What actually connects all of us? It's a green and sustainable bond that connects all of us. We all have issues with infrastructure, we have the resources, we have the natural resources, so why don't we tap into it? ETI in Lome has just done a sustainable bond, nature bond, is an ICMA dominated nature bond. The banks can also follow suit. Corporate institutions can adopt that. So not just look at what Bayport has done, what Leshego has done, they can be innovative, be creative, and we'll have a dynamic market in the next 5 to 10 years.
Right, thank you very much. A round of applause to the panel. We'll take a few questions and then we'll leave. The first one says, how can we make listed corporate bonds an acceptable collateral instrument for repo transactions besides treasury securities? Davina, you want to answer that?
Yes, the repo is actually for us. So the It's one of the issues that the traders on the market raise, that they think that their counterparty should accept repo, the corporate bond as another repo instrument aside the government securities. I would say it's a behavioral thing. The market participants, we need to drum it in that they can start using it. And then, but how can we do that if the regulator has not instituted or made it acceptable? So we, the regulators, as earlier discussed by the other speakers, collaboration, we need to talk together and then agree that as part of our repo or our GEMRA regulations, these are some of the things. The corporate bond can also be used for the repo transactions in our market.
All right. Anybody wants to add anything on that? Okay. The final question says, if rates and inflation are falling but household purchasing power isn't improving, what makes the debt market's recovery sustainable? Does anyone want to attempt that? If rates and inflation are falling, but household purchasing power isn't improving, what makes the debt market's recovery sustainable?
Yes. You see, sometimes we think we must invest from the leftovers of our finances. That's your purchasing power or the disposable income. Investment is a decision. You see, no matter what it is now, we see a lot of improvements. Now, you read the last banking survey report, and now banks even have more money than they lend. Yes, and so the macroeconomic fundamentals, being stable, always works well with the debt market. When rates were 35%, 29%, how can an issuer come to the market? What business would the issuer do to be able to make profit, to pay more than what tables, was costing? And so, fine, rates are not perfect, but investment is a decision, not, or should not be based on what is left over after you have spent. Decide to invest even alongside the spendings that you have. I think that is what I would tell the questioner.
All right, let's give the panel a round of applause. And earlier we announced that if your car was by the road, kindly move them. The able team from the Fidelity Bank have resolved that you don't need to do that. We're taking care of that. Let's give a round of applause for our team. Jacob B. Edu, Nanose Ajimandbuachi, Madame Lavina Oponkweno, Daisy Ejebwedi, Nana Safo, and Boaz Asari. Please, let's give them a round of applause as we wrap up. Thank you very much for joining us for this panel discussion. I believe they stay for a picture before they get down.
Thank you. Round of applause for our moderator as well. Let's put our hands together for the Venerable Vivian Kai Loco. Yeah. The color combination, yes. And the theme runs through it all. Thank you very much. Thank you. Thank you. Indeed, there's liquidity, but come to the table with transparency, good documentary credibility, clear and practical plan for expansion, you will get the money. Let's put our hands together for our panel once again. Ladies and gentlemen, this is the first edition of Fidelity Bank's Debt Capital Markets Conference, and so far so good, is it not? Have we enjoyed the conversation so far? Is it progressive? Does it give us an idea of what the next phase will look like? Should we do this next year? Let's put our hands together for Fidelity Bank. Wonderful. Our third and final panel will discuss international view on Ghana's debt capital markets. The international view on Ghana's debt capital markets. And distinguished ladies and gentlemen, we will have The first member of the third and final panel, Madam Barbara Tete, Senior Investment Officer, Financial Institutions Group, International Finance Corporation, IFC. She's a Senior Investment Officer at the IFC, where she has worked since 2020. She has over 22 years of experience in the financial sector with deep expertise across capital markets and banking, spanning multiple emerging and frontier markets. Barbara's work focuses on innovative financing solutions that strengthen financial institutions, deepen local capital markets, and advance financial inclusion. And it is this experience that she's garnered over the many years in this field that she brings to the conversation this afternoon, to also help us have a progressive view of how the international market also views our debt capital market in Ghana. Ladies and gentlemen, please help me make welcome Madam Barbara Tete. Let's put our hands together. Thank you very much. Next, Mr. George Asante leads and executes a fully integrated market business strategy across Africa for Citi, covering diverse client and product segments. With over 22 years of experience in African markets, George joined Citi from Absa Group, based in South Africa. He served as Managing Director and Head of Markets for Absa's regional businesses, overseeing operations in 18 countries. In this role, he notably transformed country treasury businesses into market-leading sales and trading franchises and spearheading high-profile financial market development initiatives. His prior roles at Absa included Head of Trading for Africa Regional Businesses and Head of Markets for Barclays Ghana. Earlier in his career, George served as an emerging markets cross-sector and cross-assets structurer for Barclays Capital in the UK and gained experience at Fidelity Bank Ghana and SSB Bank Ghana. Ladies and gentlemen, please help me make welcome George Asante, Managing Director, Head of Global Markets Africa for Citi Bank. Thank you. Thank you, George. Thank you very much. And to moderate this panel is Umar Kadiri English. Is a capital markets professional with over a decade of experience spanning both equity and fixed income markets. His experience across these two segments uniquely positions him as one to look out for when it comes to broad perspectives on how capital is raised, traded, and invested, and on the market structures and institutions that enable capital markets to function and grow. Through his career at the Ghana Stock Exchange, Umar has built extensive market experience and contributed to the evolution of Ghana's capital markets. His exposure to both equity and fixed income gives him a distinctive understanding of the interconnected nature of the markets and the opportunities for building deeper, more efficient and resilient capital market ecosystems. Umar, in his work, underpins a strong interest in the continued development of African capital markets and their ability to connect capital with opportunity. He speaks English, but financial language as well. Please, let's put our hands together for Umar Kadiri English, Senior Officer, Ghana Fixed Income Market. Let's put our hands together for Umar. Thank you.
Hello, good afternoon. It's a pleasure to be here. I think we have just two people on my panel, so this is going to be cozy and more intimate than the previous panel. All right, so Ghana has come with some ways from the painful DDP experience. Currently, we are experiencing some significant economic growth. All the economic indicators are trending in the right direction. The fixed income market has witnessed a remarkable recovery. We are seeing increased activity, not only in the tickets that we are seeing, but also in the number of transactions. We see some activity also in our corporate bond market. One of the key segments in our bond market that we are looking to improve. But we as local investors or local players, we are very excited about what is happening currently. We see a new phase approaching, and we are quite excited about it. But the question is, from the outside looking in, how does Ghana look to the international investors? We must not lose sight of the fact that international investors play a very important role in our market. They help us in terms of liquidity, price efficiency, and then the overall efficiency of our market. So do you think international investors, they share in our optimism so far? Do they see a country that has solved these issues, that is on the brink of sustainable development, or they still see a country that is plagued by structural or systemic vulnerabilities? So I'm excited that I have you two with your unique perspectives to share your thoughts on how Ghana is performing, how we are faring compared to our peers, since we are all competing for the same pool of international capital. So my first question goes to you, Barbara. What would you identify as Ghana's key strengths as an investment destination for debt capital market?
Thank you very much, Umar. And before I start, I would want to take the opportunity to thank, and this is on behalf of the IFC, to thank Fidelity Bank for organizing this conference. We think it's very timely, and it's also quite interesting to hear the thoughts of very experienced minds in the industry. And we've listened in since the program started. And I also started my career in the capital market, right? And I have seen the extent to which this market has grown, really. In my view, and this is my view, right, I think the market has progressed very significantly, right? And I was also part of a mission that did a capital market diagnosis earlier on in the year. And that gave insights into the extent to which the market has developed. That is not to say that there aren't gaps, right? But in my view, the market has sufficient basis or premise for growth, right? That said, for international investors, when they seek to assess the strengths of markets, there are some key variables that they test. And these would include the level of confidence in the market, the investor base, and also the opportunities in the market. I'll take them one after the other. Now, the level of confidence is essentially derived from variables that include the macroeconomic situation of the country. I would not speak too much to that because in all the panelist discussions, this has come up quite strongly. Foreign investors want to see a market that is stable because invariably their investments are situated in the macro situation and those two cannot be decoupled. And so the macro situation has to be stable. Now, beyond the macro situation, investors also want to see the strength of the institutions. Undoubtedly, right, in Ghana, through institutions like the GSE, the SEC, the NPRA, BOG, etc., I believe that we have very strong institutions that are governing the debt capital markets. Now, beyond that, investors want to see the extent to which the market infrastructure functions in a way that ensures that trading activity is seamless and well settled, right? And I believe that that is also well present in our market. So really, when you assess on these bases, right, you can say that given the macro stability that the market has seen following the debt restructuring and also the reforms under the IMF program, there's a good sentiment around the debt capital market in Ghana. Now, beyond confidence, right, we can also speak to the investor base, because the investor base creates the market activity. And to this, I'm talking about the local investor base, because foreign investors are quite transient. They are mobile, right? But the local investor base is what gives resilience to the market, because they stay, they create activity, right? And they also generate liquidity. And so foreign investors would want to get a sense of what the investor base looks like, the composition, what the trends are, and what is driving those trends. Now, situating that in the Ghana context, we've seen how the institutional base has grown following the pension reforms. We've seen that averagely pension funds are growing at about 25% per annum. And as of June 2025, it was around 12 billion, which is quite substantive. Is there room for growth? Yes. But at this point, I mean, it's indicative that there's sufficient investor base, right, to drive growth in the capital market. Now, beyond the investor base, there's also the opportunities. So when macroeconomic fundamentals are good, right, when market infrastructure is adequate, and also when there is sufficient governance in the capital market, right, how does the market leverage on these, right, to create assets? Because there's the supply side, there's the demand side, and also there's the supply side. So if foreign investors are coming into the market, what are the opportunities? What can they possibly invest in? Now, you see that in Ghana, there are significant opportunities because there's a huge financing gap. If you take MSMEs, for instance, the financing gap is estimated at about 18.1% of GDP. If you take housing, right, that market is quite nascent because mortgage as a percentage of GDP is less than 2% compared to markets like South Africa, that is about 17%. Not to talk about sectors such as agriculture, infrastructure, etc. So there is a huge financing gap that presents the opportunity, right, to channel local domestic capital to provide financing through which investment vehicles can be created. So these are the ways that Ghana demonstrates strengths, right, in ways that can attract foreign investors. I mean, the DDEP was a painful experience, but that in itself has created opportunities in the market, right? Because suddenly investors are quite awake and seeking alternate investment classes. So in our view, the market shows a lot of strength. It's quite ripe for growth. However, you can always say that there are gaps. And one of the most compelling gaps at this moment is to be able to diversify asset classes and create alternate instruments. Thank you.
Thank you, Barbara. So one of the comments you raised up tees up George quite nicely, because for George, beyond macroeconomic stability, which Barbara has mentioned, what other factors mostly influence global investors' decision to invest in debt markets and commit long-term capital across emerging and frontier markets?
Thank you, Omar, and thank you to Fidelity for the opportunity. From a city point of view, we trade actively across the continent and globally. We are quite active in emerging markets and also in frontier markets, where we facilitate capital flows into the market and out of the market. And this we've done over the period. And from that perspective, when we look at Africa as a region, there are about 6 countries which we consider to be actively traded. Actively traded means in offshore or foreign investors always have an interest in participating in both the external bonds and the local securities, be it equities, government bonds, as well as corporate bonds. These countries include Ghana, South Africa, Nigeria, Egypt, countries like Uganda, Zambia, and to some extent Kenya. And Ghana is really high up there. From an offshore or a foreign investor point of view, the first consideration we normally give to be able to invest or to consider an investment as viable is the story behind the need for that investment. So if you want to borrow long term, why do you want to borrow? And what story are you telling behind that borrowing? So there were statements made about the infrastructure gap, for example. So if you tell a story around infrastructure, that is an interesting one. If you tell a story around building a housing project, whether it's for middle income or whichever segment of society that you want to address, whose housing gap you want to address, that becomes interesting. If it is an issue of repackaging mortgages, for example, or securitizing payday loans, that becomes interesting. And that is a very key consideration. I guess out of that, you will have the structuring of the instrument as well. How well is the instrument structured beyond the macroeconomics? Then you move to the point around how easy can I monetize the instrument I have? I mean, by that, what I mean is, if I buy the paper today, would I be able to credibly tell its value tomorrow, right? And would I be able to sell it if I have to sell? Or if I can't sell, can I repo it or pledge it as collateral to be able to borrow? So that also becomes very important, and maybe you can talk about it later in terms of the role of banks and the role of the regulators and how they can make that transformation happen so you have credibility in the instrument. Then we also consider or we see the need for credit analysts. So often I see a lot of information coming out of Ghana that tends to analyze either the equities or the government bonds. I think from an offshore perspective, we haven't seen much of is analysis of credit within the local market. So, I mean, if you have a friend or someone who is thinking about a profession in financial markets, I mean, there you have it. We need credit researchers who will be able to tell us about the credit and tell us in a very authoritative manner. Then I talked a little bit about valuation, and valuation is absolutely critical. How do I know that the price or the yield that is being offered to me is something worth getting, right? So I will start with where my government curve is. Where is the government curve credible enough, right? And then from a government curve perspective, if I need to go into the interbank market and raise the money that I want to invest, what kind of liquidity premium am I going to pay? And that basically tells me this is my funding cost. Then on top of that, I need to charge a credit spread. I think one of the things investors struggle with is that we know what the government curve is, there and thereabout. There is a kink. We are not too sure about why the kink is happening, but let's say it will normalize soon. What we are not sure about is the liquidity premium. There is no, as far as we're concerned, a credible interbank curve where we can borrow and say, this is my funding curve, as is the interbank spread plus the government risk-free rate to show me where I can fund that. Then on top of that, I add credit spread. So I think valuation and the concept of deriving the fair price for the instrument is something we look at. And I see that as a gap that the market probably can work on, and for investors to be comfortable in terms of buying things that they think are worth their while.
Thank you, George. So in terms of valuation, I think when the DDP happened, Ghana was introduced to PIK bonds, and that was a first for most traders and dealers alike. And there was a bit of a challenge pricing these securities for a while. But I think as time has progressed, the market is more comfortable with pricing some of these securities. So I think on the point of valuation, we've made some progress on that. And then the pricing we see on the market is quite reflective of where market should be. So thank you for that. So my next question goes to Barbara. Looking at Africa's leading debt market, what are the key characteristics of success? And how does Ghana compare with its peers, such as Kenya, Egypt, as George mentioned, when it comes to attracting local and international capital?
Okay, thanks very much. How does Ghana compare? As we rightly said, right, the market has good fundamentals for deepening and growth. But of course, you could always say that it's probably not at its potential yet. And when compared to other markets, right, you may see some form of lagging. Now, in my view, right, so we've spoken about all the fundamentals, right, which are also present. But the differences are in the depth of the market, right? Also in the scale and diversity. I'll explain. So if you take the scale of the market, for instance, now, all of us are talking about the extent to which pension funds have grown, right? But really, compared to GDP, it's about 6.1% of GDP. Now, that lags behind a market like Nigeria, which is north of 7%. And Kenya, which is about 11.4%. And significantly behind a market like South Africa, which is about 80%, right? So, which would mean that why the investable capital base has grown, right? It doesn't compare as well to some peer markets, right? Like your Kenya, for instance. Of course, Nigeria has significant scale, and so we would be mindful how we do the comparisons. So which would mean that there is significant opportunity for growth in how the market mobilizes capital. So you would see that the capital accumulation has been quite centered on institutional investors, right? or from the formal sectors. But there's also significant opportunity in the informal sectors. And aside the social protections that it gives to the informal sectors, right? Because they do not have as much, or they are not as financially inclusive, right, as the formal sector. So aside the protections that expanding the net, right, to cover the informal sector does, right, to those contributors, it also provides the avenue to be able to expand the base for capital mobilization, for instance. Now, regarding the death of the market, right? We all know that we have instruments in equities, we have bonds, right? We did a commercial paper which would be the first, but the death is quite limited. So if you compare to a market like South Africa, of course, that is a more sophisticated market. And the sophistication is evidenced in the nature of institutions, the product types, right? And the instruments, you know. But we cannot say same of Ghana because we have very limited products, right? Now, on diversity, which is also quite related, significant amounts of the investable capital is in government securities. As of 2025, I think about more than 60%, right, of the pension funds was in government securities, you know. So that is, I mean, some of the differences that we see. Corporate issuances, for instance, is about 0.6% of GDP. Now, if you compare to a market like Nigeria, you are seeing a more active corporate issuance market, right? And also for commercial papers, right? Now, if you compare to a market like Kenya, Kenya is increasingly able to use domestic capital mobilized to finance the real sector, like housing, like infrastructure. So case in point, through the Kenyan Refinance Mortgage Company, right, the market raised sustainable bonds to finance the housing sector. South Africa has issued numerous sustainable bonds, and these are going into key segments of the market, like water, utility, housing, infrastructure. That by itself contributes to depth and also diversity in products. So these are the ways that Ghana lags behind its peer comparators. And whilst these gaps exist, right, they also demonstrate what is also possible in our markets. And I hope that together the ecosystem can take the charge in a way that brings continuous transformation to the debt capital market. Thank you.
Thank you, Barbara. I had an opportunity to look at the Kenyan refinance mortgage, and I believe IFC was part of that funding, right?
So, yes, indeed, and not just for Kenya, for South Africa as well. And so, capital markets is actually a priority segment or a priority area for the IFC. And you would also know that thematic issuances have also gained a lot of momentum. So not just for the DFIs, but institutions also have, I would say, strategic intent, right, around these deliverables. So IFC, in many ways, has contributed to developing capacity in markets. That is, for instance, what the Joint Capital Market Initiative has done for these markets. And in the case of Ghana, I would say it is quite new. But yes, through that initiative, the IFC, together with the World Bank, is seeking to contribute in very meaningful ways through reforms and also through demonstration transactions that would contribute towards deepening the market.
Thank you very much.
And also, by the way, I forgot to mention that for these issuances, IFC is able to also anchor, right, in a way that provides the investing market assurances and confidence in the issuance. Thank you.
Thank you, Barbara. And then at the Ghana Stock Exchange, I believe we've started having conversations with IFC to explore this anchoring investment. Still with you, Barbara. What should be Ghana's top priorities for accelerating debt capital development in the country?
Okay, thank you very much, Umar. I think it would still go back to the earlier discussions that we've had, right? Because if we have the strength, right, then we would seek to make sure that those strengths are protected. And I heard Uncle Pienim say that if you think you're comfortable and you take a pegative in the night, see what kind of mess that it does to you in the night. So yes, the priority would be to sustain the macroeconomic stability. So on top of the minds of foreign investors, the question is whether the growth is sustainable. Yes, it's nice, inflation is down, interest rates are down, we've built sufficient reserves in a way that keeps the city stable, but the question is how sustainable it is. It's quite assuring to hear from the Ministry of Finance, for instance, that there's currently legislation, right, in a way that keeps debt to GDP ratios sustained, right? Because debt sustainability is key, right? I heard from the room that Ghana doesn't intend to go to the repo market, but in the event that the market does, right, debt sustainability, for instance, would be a key marker for assessment. So on priority areas, I would say macros, macros, macros. I don't think we can belabor the point and say it's more than enough. And I think we are all gathered here today because the macros are stable. Otherwise, the conversation would have been different, right? So the macros, we spoke about the need to also widen the investor base and also create the avenue for diversity in products. Now, beyond these, I would think, and on diversity of products, right? So when we did the mission, right, one of the key, and it was quite a resounding theme, that the market is looking for alternate investment classes, right? And I hear Abner talk about the rejection bits, which means there's quite a lot of liquidity on the market looking for vehicles to pack these in. But it also, I would think that it's also quite related to capacity, right? So not to say that the market doesn't have capacity, the market does have capacity, but these could be concentrated. But it's important to diffuse this in a way that helps the market able to actually structure and market these alternate asset classes. And the investing public must also understand, right? The market cannot invest in instruments that they do not understand, right? Because otherwise they would not be able to manage the risks, right? So these, in my view, should be should be the priorities for the market. Thank you.
So my next two questions go to George. So the first one is, how important are factors such as governance, transparency, disclosure practices, and secondary market liquidity in investor decision-making?
So maybe I'll take you from the bottom. Secondary market liquidity is absolutely important. As I mentioned earlier, when I'm an investor and I buy a paper, it's not just about keeping the paper on the books forever. Sometimes that's my intention, but I also want a backstop. If I need money, I need to be able to either convert the paper into cash or be able to monetize it by raising cash against it. And that is all driven by secondary market activities. I think for me, the key issue really starts with the regulators and how they classify some of these instruments. And to be fair, I mean, in most of the markets where we actively trade corporate paper, the leading signal you have for corporates who raise capital through the debt market will be ratings, that all of them have ratings. So the ratings is normally the starting point. Otherwise, the job for the investor becomes difficult. Then following from the ratings, regulators normally give guidance on if you have a AAA paper rated, then it's classified as HQLA, and your traders and your balance sheet managers can manage it as such. And then that flows into a lot of secondary market activity and the willingness of traders. I mean, someone mentioned ability to buy when there is no one to sell to. I mean, if it is HQLA or whatever it is, then I will be able to price for it and ensure that there is secondary market activity. So we will typically not get involved in a paper that doesn't have a guaranteed route to exit. Although our intention may not necessarily be to exit. So that becomes very important. And if it is not there, then we price up the amount we charge the counterparty who wants to raise money. So it becomes an unnecessary cost for the whole system. Then the other one about transparency, I think we can't say anymore. It's, we've beaten that quite well. But from an investor perspective, again, we want to price everything, right? So if we look at a company that is trying to issue a paper, for example, and the company is not willing to be transparent or prepared to be transparent. I mean, sometimes they are willing, but they are not prepared, right? Then, I mean, the easiest thing is to walk away, right? If we don't walk away and we still like the story, then we price for it. And then, which means you pay an unnecessarily high cost for not being transparent. And what do we mean by transparency? I think the credit analyst talked a lot about it. It's about the credibility of your audit reports, the credibility of your board, credibility of your management, and your ability to follow the rules set by either the SEC or the exchange. And I think, I mean, one of the things that probably could help in our situation and help the regulators in probably accelerating the turnaround time in approving some of these transactions, I think getting credit ratings level sets everyone. And I guess from a regulator perspective, it makes the work much easier. If there is no credit rating, where do you start from, right? It's quite difficult for a regulator. And obviously for an investor, it helps us to also bucket the risk between a AAA and a sub-investment grade and how we price that risk.
Thank you. And from where you sit, what opportunities exist for cross-border investment and regional capital market integration?
So I think that's a good question. I believe that, I mean, in our region, as in Africa, it's always easy to invest outside the continent than to invest in. That is, if you sit in the continent, I can get on my phone and invest in the US in a twinkle of an eye, but it's not easy buying a bond in Nigeria, for example. Yeah, so, and that is at the personal level, but it's the same at the institutional level. there is the need for pooling of capital across the region. And there are two schools of thoughts. One is, let's try and harmonize regulations and rules across the different platforms so that if I sit in Senegal, I will be able to issue an instrument in Ghana the same way as I will issue on the BRVM, for example. Which is a long process, and I believe the regulators are working on it across through Asia. They are working on it. I feel that, and we've tested this a bit in a market like South Africa, I think inward listing probably is the easiest, which is, inward listing is listing a security in, let's say, Nigeria as the original home for the security, but cross-listing it into Ghana. And what does it do? It ensures that if I'm sitting in Ghana, I can just get on the stock exchange in Ghana and assess a security in Nigeria as if I was in Nigeria. So I think the approach of inward listing probably cuts short the grand scheme, which is integrate all stock exchanges in Africa or within the region, and probably accelerate the ability for us to pool capital and to pool investment opportunities across the region. So for me, I would say inward listing probably is the way to go.
Thank you, George. Unfortunately, we do not have time for Q&A, so we'll have to wrap things up. Ladies and gentlemen, help me in thanking my panelists, George and Barbara.
Thank you very much. Please, this is the last panel. Let's do it better for them. Let's put our hands together for them. And they've been having the conversation on the international view on Ghana's debt capital market and how we can also access that good outlook. You recall the governor of the central bank mentioning the favorable ratings that we have, as a country, have had from the international rating agencies, and how that also influences our planning and then accessing the international market eventually. Thank you. Let's put our hands together for them as they take their seats. Thank you very much. And ladies and gentlemen, we are at the end of this all-important engagement today. And before we go, we'll take some quick closing remarks and the Deal Clinic invitation. And to do this, please help me make welcome Mr. Kwabena Boateng, Deputy Managing Director, Wholesale Banking, Fidelity Bank, Ghana Limited. Please, let's put our hands together.
Good afternoon, and I think the day has been well spent. Distinguished ladies and gentlemen, as we draw close to today's conference, let me begin by expressing Fidelity Bank's sincere appreciation to all our speakers, panelists, participants for the quality of the discussion and insights that we have shared throughout the day. And I'll say a very big thank you to Uncle Pianim. I remember yesterday we paid him a visit, and he had an issue he was grappling with. And he was like, no, guys, I will still attend. And I'm happy that you sat here the whole day with us. I really, really appreciate it very much. And the same goes to Abner for that presentation, lovely presentation that you gave to us, and all other participants on this session. This program has brought together perspectives from policymakers, regulators, market operators, issuers, investors, and international market participants around a common objective: unlocking the potential of Ghana's debt capital markets. Earlier today, our Managing Director, Mr. Julian Opuni, challenged us to think beyond economic stabilization and consider what comes first. Next, throughout the discussions that followed, a recurring theme emerged: the opportunity is real. We have heard about our ever-improving microeconomic conditions from the governor. And I remember some few things that the governor put across. He said the important transformation, and he listed three things: greater diversification of issuers, which is very, very key. Greater use of technology to deepen market participation and efficiency. Greater mobilization of diasporan savings into long-term investments. These are very, very key transformational things that he left with us. And I do believe that when we go into the Fidelity Clinic, these are some of the things that we'll be discussing. And Abner did say that there are 5 priorities for the next market phase. And this 5 is something we need to also look at. We should not just walk out of here just like a normal talk shop. But these things that have been left with us, these pointers, are things that we need to go back and have a look at. And possibly, if we have to come back next year, we should come back looking at what we've said, what has come out of it, and then the journey forward. Yet, perhaps the most important conclusion from today's conversation is that the development of the debt capital markets cannot remain a theoretical discussion. At some point, every conversation about market development must translate into transactions. Every successful capital market begins with issuers prepared to explore new funding options, investors prepared to provide capital, and advisors capable of bringing both sides together with it an enabling regulatory framework. And that's what we just did today. We had every sector of this coming to talk to us about exactly what role they play and how we can join the dots together. That's why Fidelity's view today's conference, not the end of the conversation, but as the beginning of one. We recognize that for many organizations, the prospect of issuing a bond, establishing a note program, raising structured financing or accessing institutional investors can appear complex. Questions naturally arise around investor appetite, readiness, ratings, pricing, tenor, transaction structure, and execution timelines. These are practical questions, and practical questions require practical solutions. It is that spirit that I would like to invite all interested participants to engage in the Fidelity Capital Markets team over the coming weeks. We need to continue. The purpose of the Deal Clinic is very simple. It provides opportunity for issuers, corporates, sponsors to engage directly with our specialists and discuss their financing requirements in confidential and solution-oriented setting. That is very important, that we should have that clinic and have the discussion of what are your needs, what can we do, what is it that seems so complex to you that you do not understand, and we'll break it down to the simplest form for you to be able to understand. Whether you are considering expansion capital, refinancing existing facilities, funding infrastructure, supporting working capital requirements, or exploring future capital raising opportunities, we would welcome the opportunity to discuss how the debt capital market might fit into your funding strategy. Our objective is not to persuade every business to issue a bond tomorrow. No. Our objective is to help organizations to understand the range of financing options available and determine the structures most appropriate for their specific circumstances. If today's discussions have sparked ideas, raised questions, or revealed opportunities within your organization, I encourage you not to let the conversation end when you leave this room. Continue the dialogue. Challenge conventional thinking around financing. Explore possibilities available through the capital market. Most importantly, begin preparing today for opportunities that tomorrow's growth will require. On behalf of Fidelity Bank, I thank you once again for your participation, your enormous contribution, your commitment to supporting the continued development of Ghana's capital markets. We look forward to engaging with many of you at the Fidelity Deal Clinic in the days ahead. I wish you safe travels, especially those who came from far and wide, because there are some people who travel all the way to join us for this session, and we thank you very much. And then fruitful conversation over lunch. And every success in your businesses and institutions. Thank you very much, and enjoy the rest of the afternoon.
Thank you very much, Mr. Boateng. And I'll kindly ask the ESCO of Fidelity Bank, Ghana, to come up stage. And we would have the speakers for all the panel who are here to also please come up stage. Want to take a group picture behind the screen. And then also our moderators, please join them. Ladies and gentlemen, if you could kindly come up stage so we have a quick photo. It's a group one. We have all the speakers, the moderators, and the ESCO of Fidelity Bank. This is one that will remind us of the achievement today and why we should continue these meaningful, progressive conversations in the coming years ahead of us. Ladies and gentlemen, we thank you very much. And while at it, we have lunch served. The ushers will lead our invited guests to the lounge, and all others as well would have our lunch at the restaurant. And it is a buffet, so please, those who had the codes when you were registering, you were given a code after registration. You'll be given a lunch coupon, and all participants who have not registered, please do so, or take your tags at the registration desk, and that's when you'll be giving the code. If you do not have your tag but you registered, kindly go to the registration booth. They would help you with the code and also the coupon. So please, that's just for the information of all of us. For those of you registered who do not have the code as yet or the coupon, please go to the booth and get the registration done. And just as Mr. Boateng said, opportunities are real and tangible, and Fidelity Bank will take all the diagnosis of the challenges as I highlighted and the suggestions that have been made today to bring it to fruition and reality. Practical challenges, practical solutions. Let's put our hands together for Fidelity Bank Ghana Limited for putting together this all-important conversation today. Is Fidelity Bank's first Debt Capital Markets Conference on the theme Lower Rates, Higher Opportunity, Unlocking Growth Through the Debt Capital Markets. Ladies and gentlemen, thank you so much for coming. Are we going to do this next year? Do you want us to do this next year? Should we do this again? Those of you who want us to do it, say aye. If the ayes want us to do it, let me hear you say aye. Wonderful. The ayes have it. Thank you very much. Let's go have lunch. My name is Alfred Okanse, and we'll meet again next year. Thank you.
Hi, I'm Kukwa, and let me put you onto something amazing. It's called the Pan-African Payment and Settlement System, or PAPS, on the Fidelity mobile app. With PAPS, I send money straight to bank accounts across Africa. No stress, no delays. From Nigeria to Kenya, Liberia, Zimbabwe, even Rwanda, transfers are fast, secure, and way more affordable. So what are you waiting for? Download or update your Fidelity mobile app and try the PAPS feature today.
The current macroeconomic environment has created the opportunity for corporates to enter into the debt capital market. And the question is, are you ready to invest? On the 27th of August, Fidelity Bank is bringing regulators, issuers, and investors together at the Palms by Eagles for our Debt Capital Market Conference. We'll be having important conversations around credit quality, transparency, and governance. The Governor of the Bank of Ghana and the Deputy Finance Minister will be joining us, along with key regulators and market operators shaping the market. So, if you manage capital and want to have first-hand insight into what's coming, make sure you are in the room. See you there.